a fantastic beginning to our day 2 of DC FinTech Week. This panel explores what financial inclusion means in the context of financial technology and really the paths by which the international community is exploring and experimenting with mission-driven innovation. And we have two of the best to kick off today, people who are really on the forefront of thinking through what kind of direction, again, the international community and really the world should be thinking about some of these issues. I have the pleasure and the honor of reintroducing everyone to Augustine Carsons, the General Manager of the Bank for International Settlements. And today we also have the special treat of Kristalina Georgieva, who is the Managing Director of the International Monetary Fund. Now, this is a special treat, a great conversation, and I'm really, really excited to kick it off. Welcome to you both. Managing Director, I guess I'll start off with the IMF first. What comes to mind for you as the head of the IMF when we talk about financial inclusion? What financial inclusion means kind of differs and varies. What does it mean for you?
Thank you, Chris. Fantastic to be with Augustine and to the Georgetown students, Hoya Saksa.
You are
good morning, good afternoon, good evening to everybody. So what comes to mind is that with financial inclusion, we have now 1 billion people that were excluded before joining the functioning of the economy. And what we know is that digital money and digital transfers are making our societies more inclusive and our economies more productive. But we also have to manage risks. So what do we do at the IMF? We are invested in how financial technology changes the way economies and financial systems function, and how the international monetary system adjusts to these technological advancements. Within financial technology, digital payments, digital money. We know that digital payments truly revolutionized the lives of people. I mentioned the 1 billion new users, but even those who were included before, they see more opportunities and lower costs. Leapfrogging is a reality, and we saw it very strongly in the context of the pandemic. And so let me just make 3 broad points. How access to digital payments fosters financial inclusion. First, now for all the women that are listening, fintech helps narrow gender gaps faster than traditional finance. We have seen the share of women with mobile phones greater than the share of men with mobile phones in the Philippines, Haiti, Lesotho, Botswana. More women means better opportunities for their families, their communities, their countries. Second, the thing that we sometimes don't pay enough attention is that digital payments offer our first step into formal financial inclusion. So what we have is previously informal market participants accessing loans and other financial services, in other words, becoming part of the formal economy. And the third thing that is very, very important, when users can have access to savings, to payments, everybody is better off, but it is particularly visible for low-income households. So the poorest people, in relative terms, are those that gain. Now, all of this is great, but we also have to be clear that it's not all perfect, and there are problems to wrestle with. Problem number 1, well, we need the technology to be in place. If the technology is not there, inclusion is hard to happen. And this uneven access to infrastructure, but also to institutional capacity is something that for the fund is a big obstacle to overcome. We also need to remember that we may have, through financial inclusion, digitalization, fintech, a bit more vulnerability. Why? Let me just say one word: cyber attacks. So we have to be very prudent in advancing financial inclusion, but doing it mindful of prerequisites and managing risks.
You know, that is a great way to sort of frame the questions. I've got to say, as a Georgetown professor, it's so fascinating, you know, to see the IMF tackling this question of financial technology and also the inclusion side. The IMF has its traditional focus, you know, on these larger macro questions of financial stability. You know, and certainly financial technology from time to time has created risk in that way. But to sort of think about as well the opportunities and the IMF's role there is really something that is fascinating. And just sort of a quick brief follow-up, do you find that to be part of then the evolution of the IMF's mandate? I mean, when you think about, again, financial technology and how it's impacted this overall question of inclusion.
Well, the simple reality is, if we used to say before the future is digital, we have to accept that the future has arrived. And for us, for the international monetary system, for the way countries develop their monetary policy, we have to think about the role of technology, digitalization, as I said, digital payments and digital money, and then integrate that in the way we think of international monetary system. And that is fascinating. And I'll give it just one little snippet. And it is something that we must do for our members. We did a survey of our members, how many of them are thinking of CBDC, central bank digital currencies. 110. So we have 190, 110 out of them, some in very early stage. They're just thinking, what is it, what we should do, all the way to the Bahamas that issued the first CBDC, the sand dollar. I was with the Caribbean countries yesterday. Well, quite a number of them are advancing in that direction. We know China is piloting, and we know that there is already a work on interoperability of central bank digital currencies that Augustine can talk about, because they're leading this work. So, simple fact of life, we have to embrace it, and we have to make sure it works for everyone.
Thank you so much for that. And indeed, just yesterday we had Timothy and Antoine from the Eastern Caribbean talking about their CBDC project. Mr. Carstens, you know, you've obviously joined us yesterday. You've just been brought up now. And again, you know, the BIS and the evolution of the BIS, I tell my students, is just a fascinating story. And your own career has been one of evolution. I mean, you've been had a past role as the finance minister of Mexico, the governor of the Bank of Mexico, and your mandate in those roles has also had you know, this very interesting engagement with inclusion. When you look back over your career, and then when you think about where you are now at the Bank for International Settlements, you know, again, inclusion can mean lots of different things. Maybe it's evolved for you over time, but what do you think about this question of inclusion? And are there any key innovations that you see or that may be particularly helpful, or policies that you think may be especially supportive of achieving financial inclusion?
Well, thank you, Chris, very much for having me. And I certainly support all the comments made by Cristalina. Your question is very, very important. What I have learned are many things in financial inclusion. I mean, one of the things that you need to do as a public servant is to learn from the challenges you have had, and really to try to fine tune through time your strategy. I think probably the most difficult issue with financial inclusion is that you need to bring several critical things together to work at the same time. I mean, we can talk a lot about technology, and for example, FinTech Week is a great opportunity to talk about the technology. But we also need regulation. We also need electricity. We also need the broadband brought to the remote parts of the country. So we need to work. I would say central banks, ministries of finance, they should try to work as a catalyzer to bring all the elements that are necessary together so that it is possible to do precisely financial inclusion. One that, for example, I think is key and that implies many hurdles, both from a political front, but also from the logistical point of view, is the issue of identity. I mean, basically, to do financial innovation, you must map unequivocally one person with a set of numbers that are, or characteristics that are unique to that person. It can be biometric, it can be in different forms. But if that doesn't work, the whole system will not work. And I think that oftentimes, especially very, very poor people, it's really sad to say that what they lack is an adequate identity, you know? And that I think is so primitive, but I think that technology today can really help us jump that hurdle. I think another very important issue that the technology is bringing now is that for many, many years, we have been trying to deal with financial inclusion sort of in a piecemeal fashion, you know, but what we have seen in very, particularly in very successful cases like Kenya, like India, like the Philippines, to some extent Mexico, is that technology, and Cristalina mentioned this work, allows you to leapfrog. I mean, for many years, especially in the past, we were sort of trying to improve and affecting the margin a certain problem to make the system work better. But suddenly, and basically the legacy problems was like you know, like a burden in our, like a cannonball in our leg, you know. But suddenly we can get liberated of those cannonballs if we embrace technology in a broad sense. I mean, not solving everything, you know, but technology really allows you to start on a clean slate, you know, and reduce many of the problems that are out there. Like, for example, one aspect that we're working at the BIS is precisely how, for example, if we have a whole new CBDC design, which basically implies putting new rails and completely different rails to make payments, you can precisely, and Cristalina mentioned that, make them interconnected and interoperable across the world, so that you don't have to depend on the correspondent banking network. Now, you see how correspondent banking works is one issue after the other. I mean, there are so many steps that you have to go through, from, you know, AML CFT, from Forex, from messaging, and so on and so forth. Things are not integrated, and therefore, if they're not integrated, and to some extent they're artisanally brought together, they work, but these artisanally brought together, the costs are tremendous and the delays are huge. Now, what you can manage to do is to design everything integrally with integrity so that you make a system that is consistent. So I think that's a huge opportunity we have, given what technology allows us today.
Yeah, you know, the issue of CBDCs is obviously a big one, and even last night I was at one of a very small gathering, and we were talking also about this question of digital identity and just how important digital identity is, and trying to figure out where does that fit relative to other kinds of innovations. Dr. Georgieva, you know, the IMF has made some interesting statements as well. I mean, certainly the BIS has been focused like a laser on this issue of CBDCs, but the IMF has also made some very interesting statements in the world of cryptocurrencies. Certainly, some people view that as a kind of correspondent banking a solution, but the IMF has really spoken out carefully, but over time more explicitly. Maybe could you share a little bit more about sort of the IMF's posture and what cryptocurrencies like Bitcoin may mean for the IMF? And then when you hear the conversations and you think about that CBDC, central bank digital currency conversation, how does that all fit, again, in this larger discourse on innovation?
But the main objective of the IMF is to make sure we have financial stability and macroeconomic stability. And so we look at the question of money from the perspective of how it serves the economy to create more dynamism and to connect different actors in a way that is both good for growth, but it is also good for stability. So we look at the issue of digitalization and money in the following way. First, we have central bank digital currencies. They do what central banking authorities are supposed to do, which is to create finality in settlement and to have a credibility, trust of the population. So there is a very important role for the development of central bank digital currencies in that sense of what traditionally central banks do. Then we have e-money or stable coins, private sector issued. They are backed up by assets, and those that we see picking up most effectiveness and use, like M-Pesa or the USDC, they are exchangeable in the national currencies. They produce a digital equivalent of what we have had over the years with fiat money. And then we have crypto assets. They are not backed up with assets the same way CBDCs are backed by the state and privately issued digital money are backed by assets. Why we are careful about crypto assets? Because they are more like an investment opportunity than they are in the traditional way of serving as a stable storage of value, and one that you can rely on in daily operations. So if you are a finance authority, very difficult to have a budget that is based on a crypto asset where the value of this asset goes up and down. Very difficult to plan your expenditures. And that is why we differentiate between CBDCs and e-money, stable coins, and crypto assets from the perspective of a monetary policy that is based on predictability of the functioning of this asset. Now, this being said, I want to stress that for us at the fund, it is critically important to recognize we need both the public sector to engage, and we need the innovation that comes from private sector. Augustine said something very important. Regulation matters. If you look at the e-money and stable coins, they can deliver a lot to the economy, provided they can be trusted. And that trust is related to a sound regulatory environment. I would love to see more of this public sector, private sector collaboration, where the public sector does its part well and the private sector does what the private sector is fantastic for, to innovate. So one side regulates, the other side innovates, and the result is we have a more dynamic economy.
Yeah, we've certainly seen from the international community, and you know, hat tip to the BIS and talking to some of the staffers and looking at some of those pilot projects, you know, an interesting degree of coordination across the board. You know, if we're going to look forward, particularly with the BIS, you know, the BIS for sure does more than just CBDCs. We talked briefly about digital identity. We've had now a comment on stable coins. But you know, when it comes to targeting the question of inclusion, this is our Inclusion Day. Over at the BIS, are there any other kinds of potential projects that you have in mind in terms of expanding the inclusion debate and the work of the bank?
Yes, of course, there are many different issues that are being worked at the same time. One is just to take, for example, the idea of the India stack, where you have payments, you have identity, you have systems to authorize your data to do different forms of transactions. I think that the India stack is a great innovation that has been put on the table by India, and I'm sure that Nanda, we will hear from Nanda Nilekani about it. That can be multiplied, and that can be made much broader, and I think that's a path forward. That doesn't depend, for example, on CBDC. Another very interesting project that we have is that most countries have already RTGS, and many of them has fast payments services. So what we're trying to do is, instead of waiting to have a network of CBDCs, is just to hook up, interconnect in an efficient way those RTGS systems and those fast payment systems.
Yep.
We talked about regulation supervision. We're doing a lot of work on RegTech, SupTech. We know that, for example, in remittances, a huge cost come from AML CFT, come from foreign exchange transactions.
Yep.
So how can you automatize them in such a way that AML CFT and the issue of foreign exchange is made seamless? And you know very well, AML CFT is an issue not only for international payments, but is also extremely relevant for domestic issues. So there is the scope of how can we use innovation to improve inclusion is huge. Another very important chapter we're working on, it's a very key discussion, is how can we use data. We know that financial transactions, especially on the credit side and so on, depend on data. Now, who owns that data? Who can use that data? For many people, that the only way that the bank can know them is through their transactions. How can that data on transactions be used is very relevant. But we need to have very clear rules. So that's another huge area where we are engaging just to make this possible. As I said at the outset, we need to act from different sources at the same time and bring together a critical mass so that financial inclusion really can leapfrog in the coming years.
Yeah, it is definitely not your grandfather's BIS. That particular list of things it's almost when you think about the origins,
And it is not your grandmother's IMF.
It is not. It is not. I was just about to say, we have about 30 seconds, but I saw the TV land did not see you shaking your head in approval of these things. I didn't know if you had with just a couple of seconds left, like any other interesting things that you wanted to add. I just saw that you were very enthusiastic.
I just wanted to say that we need to think comprehensively. Digital identity matters tremendously, but so does privacy. And how we connect all these dots for a world in which we can trust the digital space. It is doing good rather than underpinning crime. And it is helping more people to be part of the economy, contribute and benefit from that. This is our task.
Wonderful. Yeah, I'm very much looking forward to actually next week and going back to class and literally breaking down this conversation in its component parts. Thank you so very much to both of you for coming. You're wonderful, and I appreciate it. I will now be passing on the baton to my colleagues over at the BIS to talk about the India Stack and to talk with one of the individuals who can be truly credited with changing the face of a country's economy and the global economy. But again, thank you to you both for joining us.
Thank you.
Thank you. Bye-bye.
Bye.
Good morning. Many of you are joining us over breakfast in the Americas, on tea in India, and over dinner in Hong Kong. So morning to you, evening and afternoon where you are. I'm Siddharth Tiwari, the Chief Representative of the BIS in Asia, anchoring this out of Washington. The previous panel has set this panel up really well with Augustine talking about different parts of the India Stack. And amongst technologists and policymakers, Nandan needs no introduction. And he is our guest today to talk about the India Stack. Nandan, welcome.
Thank you.
And in your illustrious career, you worn many hats. You're the co-founder of Infosys and the chair of Infosys, right now a large Indian multinational corporation. But you're also known as the brains and the person behind Aadhaar, which is a practical way to prove one's identity for 1 billion Indians. Aadhaar has importantly been critical in closing the gender, income, employment, education gap in India. But more generally, you've spearheaded the digital modernization of India. And more recently, you brought the message of inclusive internet to the global audience, not least through what Augustine talked about right at the end on the democratization of data. And you are a prolific writer with your Art of Bitfulness to come out later this year. Sometimes I wonder, how do you get the time to do it? But having worked with you, I think you're the most prolific person I've seen. So the way I'm going to do the conversation is I'm going to try and walk us through the India Stack, and I'll go from the bottom and go up. So just to start it off, that India made more rapid progress in financial inclusion than any other country in the world. India went from around 1 in 4 individuals with bank accounts in 2011 to over 80% in 2017. That's the last date for which data is available. Moreover, the growth included women, less educated, poor, gaining much more access than before. Can you describe for the audience the breakthrough in technology and innovation that made it possible? And also, how did India, in a highly bureaucratic economy, make this happen and make growth more inclusive?
Thank you, Siddharth, and thank you for that wonderful question. It all began in 2008, actually, when I wrote my book, Imagining India, where I talked about the need for a digital ID. And then in 2009, there was an election which the UPA government came back with a stronger number, UPA 2. And I got an invitation from the Prime Minister, Dr. Manmohan Singh, to lead this project. So at that time, I was, co-chairman of Infosys at a nice corner office overlooking a golf course. And I gave that up and moved to Delhi to do a startup inside a government. And it was one of the most challenging assignments I've done in my life. And the idea was to give every Indian a unique ID so that a person had only one ID. And the reason for that was twofold. One was that many Indians, and even today, many of the births that happen in some states, more than half the births don't register at birth. And therefore, they have no documentation or proof of their existence. And that was fine when they lived in the small village. But as they started migrating to big cities and so on, having some kind of proof of identity was very important. So one reason was inclusion, to get everybody an ID that could say that John is John, Ram is Ram, Rahim is Rahim, or whatever it is. The second thing was India had started a few years earlier in building out its social welfare program so that millions of beneficiaries could get direct benefits, including pensions, scholarships, unemployment insurance, and so on. And they found that without an underlying ID system to identify the beneficiaries, there was a lot of ghosts and duplicates, and therefore it led to leakage and corruption in the system. So these are the two drivers. And that's how I got roped into this. I became the chairman of this new entity called Unique Identification Authority of India, which came up with the Aadhaar project. And I served in the government for 5 years. By the time I completed my term, 600 million people had the ID. And subsequently, when the new government under Prime Minister Modi came, I had a meeting with Prime Minister Modi. He was very supportive of this idea. He's been a big champion of it. And today, 1.3 billion Indians have the ID. Now, it's not just an ID, it's a digital ID. And we didn't realize at that time, but having a digital ID which was secure, which was privacy protecting, was very important. And this came in very handy because along with the ID, we came out with the idea of linking the ID to the bank account. And so the Aadhaar was linked to the bank account. And you could do what's called as an electronic KYC, where using your Aadhaar ID, you could open a bank account in 1 minute, just doing a KYC and an online authentication. And that's one of the reasons of the acceleration of financial inclusion. And between 2014 to now, maybe 700 million new bank accounts have been opened, largely using the Aadhaar eKYC. And during the pandemic, it served as the basis for the world's largest cash transfer program, where people could get money into their accounts in minutes. And then we built something else called the Aadhaar-enabled payment system, which allowed people to withdraw money in a village using a business correspondent and just their number and a biometric. So we had this ID plan, which was state of the art. It was based on the cloud. Today, that system does about 50 million transactions a day of authentication and 5 million KYCs a day. And this has been the fundamental sort of platform. The Aadhaar actually means platform, which has helped in transforming financial services and identity for 1 billion Indians.
So Nandan, just very quickly, before we go on to the next question, India does things on scale. Usually in India, it's in billions, when in other countries, it's in thousands. I remember when you started out, the worry was, how could such a large data system be kept secure, both from the official sector and from the private sector? So maybe in 30 seconds before we go to the next question, how was that managed?
Well, first of all, we collected minimal data, only the name, address, date of birth, sex, and biometrics. By law, it cannot collect any more data. The data is not shared with any other entity within the system. When people get the number, they have to keep it private. So a whole set of technical and legal infrastructure created to preserve the privacy as well as the security of this very vital data.
Great. So we move along the stack. We go to the next layer. The next challenge for India was to create a payment system or the unified payment system, which was launched in 2016. And many people have looked at it, and it is a marvel from different lenses. It allows users to move money seamlessly between various banks and financial service providers directly from their mobile phone. It is interoperable, it's fintech friendly. As I mentioned already, India does things on scale, so it's 3.25 billion transactions a month, operates 24/7, 365 instantly, costlessly. And going back to the previous panel, it settles in fiat money inside the central bank. So there is no tug of war between innovation and regulation. The architecture is big tech friendly. Google Pay, WhatsApp Pay operate on it alongside commercial banks. How did this materialize, and what were the key steps in getting it this far?
Well, the UPI, which is really an amazing innovation, was built by the National Payment Corporation of India, which is a non-profit company owned collectively by the banks, and set up the RBI for India's retail payments. Coincidentally, it was set up in the same year as UIDAI in 2009. And when I was the chairman of UIDAI, I'd worked closely with them on all this Aadhaar-linked bank accounts and all the other stuff that we had done. So when I, finished my term from government and came back to being a private citizen, I was talking to NPCI, and we all felt the time had come for a state-of-the-art mobile payment system. So NPCI appointed me as an honorary advisor on innovation and public policy, and a bunch of people, including the then CEO Hota, current CEO Asbe, Dr. Pramod Verma, who had been the after Aadhaar, we all worked together and came up with the design of this system, which is absolutely state-of-the-art, and in any bank account in real time, and again designed for population scale. And we launched this, or rather the government and the RBI launched this in 2016, in May of 2016. And in October of 2016, it was doing 100,000 transactions a day. And then, as you know, on November 6th, the government selectively demonetized certain currencies. And that created a huge impetus for digital payments. So the government then used the UPI platform and created an app called Bheem, which the Prime Minister launched end of December 2016. And then over time, because of the open architecture, many private innovations would come. So you had Google Pay, WhatsApp Pay. In fact, the most successful one is called PhonePe, which is a company owned by Walmart. There's Paytm, which is a very successful startup. There's Amazon Pay, Apple Pay. So basically, it opened up payments. The beauty of this model is that the consumer-facing distribution apps can use this payment, but the account is with the banking system and under the Payment and Settlement Act of India of 2007. So it basically combines the strength and rigor of the banking system, fiat currency, and it provides all the innovation that people want: inclusion, low cost, highly scalable, and basically in real time. And it's all done with fiat currency. So in many ways, all the so-called benefits that people talk about with new approaches has already been solved. And it really has the right balance. And now, thanks to the BIS and other observers, many of the countries are looking at this, and NPCI has set up a company called NPCI Global, basically to get other countries to use this technology. And as you mentioned, last month it did 3.6 billion transactions. And the NPCI CEO has gone on record to say that the goal is to go to 1 billion transactions a day. So this is really changing. The beauty of this is you can go somewhere and see a vegetable vendor accepting UPI payments, that they realize that you're really democratized payments.
All right. So let's move on to the next subject, which both Augustine mentioned and you mentioned before, on democratizing data. from payments to data. Recently, you've spearheaded the creation of data governance and consent architecture, where individuals and SMEs that create their own data can benefit from it. Would you describe a little bit on what are the technological challenges that need to be overcome and how it will benefit individuals and SMEs?
Well, I think this is the first architecture in the world where instead of data being collected by companies or by governments, data is in the hands of the individual. And the individual is empowered to use his own data in any way, individual or a small business. And this is available to 1 billion people and to 50 million businesses in India. And that is something which is unique. And it's been launched initially for lending, for example. So if I'm a small business, I can use my digital footprint. I can use my invoices or my, a thing like my tax returns and get them from the respective data from the respective locations, fully encrypted, and on a consented basis, give it to a lender who can give me a loan. So the whole idea that data belongs to the individual or to the small business, the democratization of data is the unique idea which is there. And we think this can be applied not only in financial services, but health and other sectors. In fact, India will be applying the same concepts in the health sector. So this fundamentally is turning data on its head and giving data to everyone to use for their future. That, I think, is a globally salient phenomenon.
Great. I'm going to move it from the India stack to United States. We are in the nation's capital here. And the debate in America about data and big techs has raged for years now on both sides of the aisle. So for our audience here in the nation's capital, my question to you is, how do you think it can be done in America? What should the US government do to get the interests and activities of big tech and the use of people's data to be aligned with the interests of the population? If you were to recommend one thing, what would it be?
Well, I think fundamentally, Siddharth, it's about creating interoperable system in whatever we do. When you create interoperable systems, when you have standard protocols for messaging or passing data, when you can empower people with their own data, then you end up with creating a more competitive environment, and you don't really create a winner-take-all kind of environment. So that's the heart of what we do. We have done in the India stack, which is to open it up so that multiple players can compete. And we have had this before. I mean, when you talk about email, when I send you an email, it doesn't matter. I don't really care which email provider you use or I use. When I make a phone call to you, I don't know who is your mobile provider. When I book a plane ticket, it combines, multiple airlines and gives me a composite ticket. So we are used to interoperability in many parts of our lives. But if you have systems where you can only talk to somebody else who has the same system, then you end up with a challenge. And therefore, I think apart from the regulatory aspect, I think there's a technology aspect, which is how do we create and encourage interoperable standards, which allow people to take the data, migrate to one new, more innovative app, use their own data for their own future, and all those kind of things. So I think the techno part of it, you can't just handle this with just legal and regulatory things. You need a technological approach, a combination of technology and legal regulation. And I think the work done in India, whether it's the data empowerment architecture, whether it's these open protocols, are really what is also required. And it's not a new idea, it's been done before. The internet itself was based on open protocols.
Great. So one final question. We are all obsessed with technology and the internet, and your life is a shining example of it. And then you turn around and you write a book about taking a breather from it, the art of bitfulness. In the 30 seconds you have, do you want to give us a one-liner on the book?
Well, it's actually not a book that's against technology. It's a book that is pro the person,
right.
and
right.
it's how how to use the cornucopia of technological riches that we have to lead a better life, to lead a calmer life, and get our value for it instead of giving the value to somebody else. So I guess that's in a nutshell is what the book is about.
Great. So with that, thank you, Nandan, for this very insightful conversation. And I'm sure that in our audiences in the Americas and in Europe and Asia, you've kindled a spark in many inquisitive minds. With this, I would hand it over now to Chris for the next panel. Thank you, Nandan.
Hi, I'm Kay Turner, Senior Counselor to the Director of Treasury's Financial Crimes Enforcement Network, or FinCEN. I'm in a newly created role to lead the agency's thinking on digital identity, inclusion, and digital payment infrastructure. I have the good fortune to have with me an esteemed set of panelists and a fun task. Chris Brummers asked us to design digital identities. This task is right up my and my fellow panel's alley. We have Pramod Varma, who worked with Nandan and was the chief architect of India's identity system Aadhaar and the India Stack, among other wonders. He has worked in the US and is familiar with the US identity system. I've got Pam Dixon, a privacy expert who's considered identity issues for the past 30 years and founded and runs the World Privacy Forum. I've got Mike Timoni, who's Vice President of Secure Payments at the Federal Reserve Bank of Boston. He's responsible for designing, developing, and implementing key elements of the Fed's payment security strategy, including a focus on fraud. I've got Olivia White, who's written extensively on and designed a digital identity framework to understand its potential growth, inclusion, and innovation impact at McKinsey. And prior to FinCEN, I spent the last couple years designing and implementing system scale programs in payments, lending, and broadband, and thinking long and hard about digital identity. But before we start, I'd like to provide some context about digital identity within financial services and how it can enable FinCEN's goal of verifying people seamlessly, reliably, and in a privacy-preserving manner. FinCEN, as the administrator of the Bank Secrecy Act, regulates and enforces anti-money laundering rules across US financial institutions. Our regulations require financial institutions to verify certain customers' identity. FinCEN also works with international and domestic partners to identify and investigate illicit actors exploiting the financial system as the US Financial Intelligence Unit. This past year and a half has underscored the importance of ensuring everyone is financially included and able to access support through traditional and digital channels. For us, financial inclusion is an enabler. It broadens the reach of financial crimes controls and thus the overall integrity of the economy. But the pandemic also highlighted that identity proofing, verification, and authentication are challenging with so many disparate owners and models for identity attributes and credentials. Government credentialing, the authoritative source of identity, largely remains paper and plastic based, although there are emerging government identity services. Uneven implementation of IT standards have led to data hacks and exposed personally identifiable information, which makes those other data sources less reliable. As a result, between February 2020 and June 2021, FinCEN received over 330,000 suspicious activity reports, or SARs, from financial institutions and industry referencing COVID. Government program-related SARs accounted for nearly 6% of the 4.8 million SARs filed. It's unusual to have such a large amount of SARS filing connected to a single issue. In this case, potential COVID-19 related fraud. Reported account takeovers where compromised usernames and passwords were used rose by 12% to $6 billion. Cyber event SARS, where stolen data that drive future identity compromise expanded by around $3 billion to close to $8 billion. We view identity as a national security issue. We believe that reliable digital IDs, however, can make identifying people easier, cheaper, and more secure. They can also help reduce the cost of financial services by assisting to meet transaction monitoring requirements and minimizing weaknesses in manual processes. And they can spur innovation within financial services. And we consider reliable digital IDs a positive way to counter ransomware and cyber attacks. Since identity is a network business, it's important to bring the public and private sector minds together to collaborate on the future of identity and related innovation. We're engaging with the private sector. For example, we recently hosted several days of digital identity-focused innovation hours. We're also examining government-provided identity services and identifying opportunities for enhanced shared services. There may be opportunities to better disrupt fraud through the creation and expansion of secure identity attribute validation services. We want to create a positive feedback loop of better, secure identities that financial institutions and users trust, help combat financial crime, and drive inclusion and innovation. Enough of me speaking. Now let's turn to the task at hand. Pramod, as the only one of us who's designed a digital identity system and worked in the US, what's your vision of US digital identities in the future?
Thank you, Kay, and pleasure to be here. It's a topic of great interest, and the future of identities itself is exciting, actually speaking. So, but let me just take you through a few ideas and few facts that we must keep in mind. The concept of identity itself is highly varying in different contexts. Who you are and what you represent varies very much. But here, though, in the case of financial institutions and financial services, for that matter, we are talking about an identity, some sort of a token, physical or digital, that can be used by individuals for participating in transactions. Second, another point is that consider, for example, you can consider your club membership ID and consider your state identity or driver's license or a passport. Each of them, they're all identities, but they all have wide different context in which they are accepted and trusted, and that we must keep that in mind. Identity itself, for example, the digital the driver's license, authority is simply verifying the facts, or when you make a claim. Identity is yourself, it's about you, but someone else is verifying those facts and providing a token against those verifications so that I can use it later. So it's also interesting that you must realize the pattern that one identity depends and relies on another identity. So identities are linked and they get used and newer identities get created. And we must keep that architecture open of creating newer and linked identities. So in a bank, for example, the bank, as you said, has PML requirements, or a financial institution has very stringent requirements that necessitate that only few such identities are acceptable to them. Your club membership ID may not be acceptable, whereas a state-issued ID is acceptable to open a bank account. But that is for them to decide, the regulator to decide what is acceptable, what is not acceptable. So we must clearly envision a future where a person has multiple identities, multiple identity providers, they're all coexisting and interoperating, right? So my vision in that sense of the future is that I, as an individual, whether I have many IDs, whether they're issued by private or public institutions for that matter, and all of them are digital though, digital and in my wallet, in my control. And issuers of such ID will verify those facts and authenticate at different levels. And we must make that assumption. There will be different levels of verification that happened. Not all IDs are equal and may not be acceptable. But irrespective of that, all digital IDs in future will be verifiable by an accepting party and authenticable. And that's essence of digital identity. That means ID holders have full control of their identities and how they would want to use it. And more importantly, unlike today, instead of giving a physical copy or instead of necessitating a physical presence, I can virtually interact with a financial service provider using my digital identity, make it verifiable, and the accepting party, the financial institution, for example, can authenticate me with no physical token or physical presence. And that is very, very key. That transition must happen in the future. And imagine in the future, I can open a bank account, literally connecting them automatically in a virtual fashion, making an identity claim, authenticating myself, and bank obtains a copy of that identity, verifies it, instantly opens a bank account for me and provides financial services. No physical presence, no need to provide copies of papers and so on. I think that would be a wonderful thing to have. But at the end of the day, it is about definitely where I have a choice of multiple identities. And these identities are secure in my control. And I interact with institution in a privacy preserving manner. That would be a very wonderful place to be in.
Thank you very much for that vision, Pramod. Pam, as a privacy expert, could you talk about what guardrails are needed to get from today's US identity system to Pramod's future vision?
Yes, thank you. And thank you for the invitation to be in this conversation today. I really appreciate it. This is a topic that's really important as we move into a very new and more modernized ecosystem. It's coming. So just very briefly, 3 very quick points. So the first is that almost all countries in the world have some form of national ID. To be specific, about 198. Of these countries or jurisdictions, more than half have what I would call advanced IDs. So for example, 104 of these countries have some form of digital ID, which is inclusive of collecting either iris or fingerprint, a biometric. This is very controversial in a lot of places, particularly the US, but in national ID systems, it is less controversial. That being said, let me get to the second point, which is of those jurisdictions that have national IDs, almost all of them, almost 200, have some form of robust national privacy legislation, or they have specific identity regulation that does a couple of things. First, they typically establish an identity authority or establish a ministry, perhaps dedicated to identity and digital, with an identity authority attached to that. But no matter what, there's a bureaucrat with at a ministerial level that has authority and responsibility for identity. We don't really have that in the United States at this point. And then the third thing to notice here is that if you look at the legislation and analyze the legislation that's been written around identity in these countries, there's something that's quite common across all of them. 2 things. Number one, there are strong cybersecurity provisions in identity legislation. We don't really quite have that in a unified way in the United States yet, but we need those guardrails. The second very critical guardrails is that the information, the identity data and artifacts are profoundly protected against abuse and misuse by government and commercial entities, and even individual entities as well. And we need to have this in black line legislation that is not subject to negotiation. It needs to be something that's rigorous and that people can trust, and that the government can enforce and continue to improve over time. It's a big topic, but there you go. Thanks.
Thanks so much for that, Pam. Mike, what does Pramod and Pam's vision imply for the financial sector's ability to counter fraud and synthetic identities and enable payments?
You're on mute.
All right, no, I had unmuted, sorry. So Kay, I want to echo the comment that I wanted to thank you for the invite as well. I think it's a very important topic and we're happy to be here. At the Fed and my team, we've been doing a lot of work around fraud, identity, and authentication. And when I think of identity and digital identity, I have to look at it from the lens of security and how it will impact fraud and payment security specifically. And today, it was already mentioned, current processes today for account opening or payment transaction approval, they do rely heavily on identity verification and authentication, but those processes use manual paper, government issued documents as the foundation. And that's a problem because fraudsters are usually able to obtain the right information to obtain those documents. You mentioned the PII being stolen. Well, that's exactly what's happening, right? So this continues to occur, and actually the fraudsters are even focusing on trying to get that PII more than anything. And so, you know, our identity today is really defined by that government issued ID, whether it's a passport, a social security number, or a driver's license. And that really defines, you know, who we are and how the process within financial institutions look at us. The challenge with that is a lot of that documentation or the authentication around that documentation is performed through visual inspection. And people that are looking at it may or may not be trained to say that document is legitimate or it's a fake. And so, you know, similarly on the online side, you can only test for certain pieces of information. You know, if you have a license, it might ask you the issue date, it might ask you the driver's license number, that type of thing, but it can't see the hologram. It can't pull the information that's really creating that security. So it's really not effective as well. And so when we look at fraud, you know, we think about it, you've got to stop fraud early in the cycle. And basically, identity verification is the beginning of the whole process, right? Once you have an identity, you can do a whole bunch of things, but really the financial institutions are struggling to validate that because the amount of PII that's out there available to fraudsters. And not only that, because of the, you know, I'll put it to different reasons, but there's a tremendous increase in the number of applications that are coming in online. The sheer volume of payments is growing. The problem's further exacerbated by the increased ability to digital channels, whether it's your mobile device, online access, new apps, all that type of thing, that account openings, monetary and non-monetary transactions are all these things that the banks are now having to look at. And as you mentioned earlier about the pandemic, that has exponentially grown the number of payments online that's happening. You know, because people weren't able to go out to stores and buy, they're buying online. And so the banks are having to deal with all of that and trying to identify identities as well. So, you know, there's a lot going on, but there's a lot of benefits too. So there's changes in the industry. We're seeing new types of payments coming in. People want money sooner. Payment products are emerging, new payments products are emerging, and the funds are now becoming irrevocable in a really short period of time. And so it's more, identity verification is more important this time than any time before. With that, I really just then wanted to touch a little bit on two of the key problems are new account fraud, which can include synthetic, as you mentioned. And so, you know, these identities are either someone creating a new account using someone else's information, or on a synthetic where they're actually taking pieces of information and putting it together to actually form an identity and then taking, you know, creating these accounts. And we've seen tremendous amount of increase in fraud in this space. Additionally, conventional account takeover where someone actually takes over an existing bank account, we've seen that continue as well, but synthetic has really been growing extensively. On the positive side, I do think where we can see some benefit around digital identity is that it can really help us. You know, if you start to think about a bank and what it has to do, there's a lot of cost in trying to stop fraud. One of the things it can really do, in my opinion, is it can help us become more efficient. If we're able to authenticate identities quickly, easily, I think it becomes more cost effective. And then you're not requiring a human to necessarily do it. We can rely on some of the technologies out there that can do that instead of a person having to look at it. The other thing that I see is that today's processes around authentication really cause a lot of friction to individuals. And that is a challenge. And I think it can help us out of that. It'll streamline the process so the user actually has a better experience. And the last comment is that I never say never, but the concept of digital identity is that, you know, others shouldn't be able to counterfeit or shouldn't be able to use it. And with that in mind, it's going to be difficult to replicate things like biometrics, et cetera. And therefore, it helps us move away from username and password into more of a system where we have this digital identity. And that's it.
That sounds great, Mike. Thank you so much for that. You know, you referenced innovation and efficiencies. So Olivia, could you share with us how this future world of digital identities could advance growth, inclusion, and innovation, particularly with regards to anti-money laundering requirements within financial services?
Thanks, Kay, and also a pleasure to be here today. Yeah, sure thing. So look, top line, I've done some research with McKinsey Global Institute looking at potential overall growth benefits associated with digital ID, and importantly, good digital ID, where we made a number of presumptions along the lines that both Pam and Mike and Pramod were talking about, where the digital ID is unique. You do have individual consent. Individuals do have control over data. It is privacy protecting. That said, what we found was across the world, top line growth of 3 to 13% in GDP over the next 10 years, depending a bit on the individual economy. And this ranged from largely about 3% of growth in countries like the US and the UK that are developed economies, up to of the countries we looked at, we saw 13% of potential GDP growth in Brazil. So how to get there? Or why does one get there? We looked at use cases across a variety of different types of use of digital ID. So you can use your digital ID as a consumer. And that covers a lot of these sort of financial services use cases that we've been talking about. So you can authenticate when you make digital payments. eKYC for financial institutions is addressing somebody as a consumer. That's a big one for financial inclusion, and I'll get back to it in just a second. You can also use digital ID as a worker or as an employee, for example, to get your check or to make labor markets more efficient. Micro enterprises can take advantage of digital ID. Public providers of goods and services, so government benefits, importantly. Civic mindedness, so even just to vote, we haven't talked about that in terms of economic applications, but it's really important. And then also asset ownership. I won't go into all of it, but Kay, you asked me to talk a little bit about inclusion. And what I'll say there is that digital ID quite clearly both increases use of the financial system at large. So just to give you a sense globally, 20% of unbanked women say that not having an ID is the primary barrier to becoming banked. And there are numbers like this for other people and other groups who are unbanked across the world. Once you are in the system, it's much easier to get credit extended or other tailored products if there's an identity system that says both who you are and allows you to, I heard a little bit of what Nandan was saying before we came on, to use the data in a way that is democratized, right? So it allows for the gateway to democratization of data that increases usage of credit. And all of this is done in a way that can be both safer, but also a lot more efficient and cheaper, if you will, both for the financial institution who has to interact with the customer, helps make it all digital in ways that otherwise might not happen, and also much more time saving for the individual interacting with the financial institution. So all of that adds up really to potential benefit, not to mention, quite frankly, that this also offers sort of a whole new window of opportunities for innovation. And those, I'll say, were not figured into the numbers that we used in coming up with our overall growth estimates.
So, Olivia, obviously, thank you very much to all of you for your comments. What do you mean by innovation, and how does that translate into the financial sector?
Well, there are a whole host of products that you can give to somebody if they're able to interact with you quickly and seamlessly, right? Like, it's a very, very different prospect to think about how do you offer products to somebody who you have to take a lot of time to interact with versus somebody who don't. There's a whole hosts of ways that you can establish platforms that interact with consumers. And I would actually submit that there are a variety of, in this audience, right, a whole variety of fintech products which are taking advantage of the beginnings of what digital ID could give us if it were more systematic in this country.
Mike, I see you shaking your head up and down in agreement. Do you want to add anything to what Olivia said with regards to financial services?
Yeah, I look at it from that lens of security, but I totally see that the account opening processes become better. To Olivia's point, I do think that it will be better for inclusion to get more people into the system. And, once they're in, they're going to be safer. So I was nodding my head along those lines. So.
That's great. Would love to just open it up to any of the four panelists to kind of, in the last 4 minutes that we have, if you have thoughts on what roles the public and the private sector should play. And then Pam, I see you raising your hand, so I'm glad always to have you to provide comments.
Yes, I think it's incredibly important. The United States has shown great resistance to the idea of a national ID. And I think that the resistance would be fairly equivalent to a national digital version of an ID. And I think that in order to address concerns about information abuse, and spoofing and other types of problems related to fraud, I think that it will be really important to have a robust multi-stakeholder process across sectors and across interest groups. And in regards to inclusion, we're going to have to ensure that all people are really represented in this process, all vulnerable groups, all populations. And there are no quick fixes here. Biometrics are seen as a really important silver bullet, but they have problems too. Each identity type of system and type of proof of identity has some kind of problem. We know that biometric identities, depending on the modality of the biometric, can be spoofed. Nothing is foolproof, but we can create a fine mesh of protection that gives us better chances of doing things right. And we can create a robust field of legislation and enforcement and audit and follow-up, your basic procedural and administrative controls to protect people, to protect businesses, and to protect everyone against fraud and against data misuse.
That's helpful, Pam. Pramod, would you like to share any comments given what Pam and Olivia and Mike have said?
No, I think it's wonderful that the idea of innovation and Olivia's point about KYC is played out really well for us in India. We were $20 a KYC, and that itself would eliminate millions of people, women, for example. The current KYC cost in India is 25 cents from $20. So it's not an order of one, it's like order of two reduction because we just went digital, right? So it's amazing the inclusion and the cost of acquisition, customer acquisition, cost of servicing because of the paper verification, what Mike talked about, constantly how humans verifying paper, and then cost of trust. With cost of acquisition, cost of servicing, and cost of trust dramatically reducing, you are looking at all kinds of new ways of providing products and services that we can't even imagine today.
I see, Pam, you're nodding your head. Any last comments? I mean, I think at FinCEN, we always think about the bad guys and what the bad guys could be doing with all of this information. Pam, you've talked about identity as a wave. Maybe you could share your analogy.
Yes, identity is a wave. It's a very fine mesh network of many, many details about a person. And because of this, we can construct digital identities in many flexible ways. There's not just one way to do this. And I know that we've talked a lot about the India example, which is one of the biggest, most important use cases in the world. But the US has, I think, a slightly different view toward data use and collection. And as a result, we're going to need to listen to people about how that's done. But I do think that we have to get on board with a digital identity in some way, shape, or form, because it is coming.
So with that, I'm going to have to close. I'd like to thank my fellow panelists for the helpful insight on digital identity, how it can advance FinCEN's goals. Lots of good work to be done. Now I'm going to turn it over to the next session. Thank you so much, Chris, for this opportunity for all of us to share some thoughts.
So it is a pleasure to be back, and we are going to have a new conversation, transitioning from this question of identity, but sort of, maintaining a little bit of our focus, because we'll be talking about technology in other parts of the world, with a special emphasis in this particular instance to Latin and South America. And I am so delighted for this particular session to have the opportunity to welcome Paula Arregui from Mercado Pago Payments. Many of you know the company. It is extremely successful and is really at the forefront of many of the financial and technology issues that we have been discussing and that we'll be discussing really throughout the day. Paula, thanks so much for joining us.
Chris, my pleasure to meet you, be here today with all this audience to share a little bit of what we are seeing and what's happening in Latin America as well.
Okay, so we started off the conference yesterday with a wonderful overview of what's happening in Asia. Later on, we'll have more of a discussion of what's happening in the United States. But right now, maybe you can provide us with just an overview, a 10,000-foot picture as to what the conversation of and on financial technology, what does that look like in Latin America? And what do you think makes that conversation distinct in any way from not only the United States, but also Asia, Africa, and Europe?
Well, it's interesting to share with you this part of the information. When you think of Latin America, just think that 50% of our population is basically unbanked or underbanked. But 1.5 in average cell phones are in the hands of Latin Americans. So this will guide most of the rest of the conversation that we will have today. We had the very big pleasure to read a paper that the IMF released in August, where they explained very well many of the causes that create this gap in financial inclusion in our region. So just to name a few of these causes, we are talking about a region that has a very obsolete infrastructure. We have a very restrict regulatory environment in many of the countries where we operate. We can perfectly see the lack of competitors and an industry that has been working in the hands of very, very few players. And last but not least, the credibility of our institutions is something that put this financial inclusion at risk. So in this environment is where we as a fintech arise with this big dream and purpose of democratizing the financial services. We think that that can be done basically not only by creating the tools for a very big and massive audience that many times did not have the place where to go to solve this type of needs, and also by educating our population on how to use these new tools. In this very big purpose, we see technology as the enabler on how to do this, basically because of three things. First, usability. Remember, 1.5 cell phones in this personal computer that we carry every day, everywhere. So designing products that can live at one touch in the screen of your cell phone, it's really one of the key metrics for success. Then scalability. When you're trying to onboard hundreds of thousands of people at a time, you have to perform, you have to be creative on how to make that onboarding, and your infrastructure has to be very, very strong in order to achieve these exponential growths we are seeing year after year. And finally, the innovation that you can bring on top of technology. Imagine you need to know people from a different side to create new scores, risk scores, credit scores, to rethink the product that you are putting in the service of your audience in a very different way. Not only the value prop of the products, the sales channels you will bring, everything has to live in a digital environment. So technology is our key enabler to do that.
Yeah, you know, that's really a series of challenges that I find from region to region. It's fascinating, right? Yesterday we had a conversation with Tim Antoine, who's the governor of the Central Bank of the Eastern Caribbean, and he said, well, digital payments is important to us because well, we're a collection of islands. And so given the terrain, digital works better given, not just distances, but the terrain. When you think about something like Latin America, where you have the potential for, an enormous, to scale quickly because there is more infrastructure in some ways than in other parts of the world, but it's still, you have this very large paradox because you still have a very large unbanked population, even though you can sort of see where you could go for that infrastructure. I think that makes the region a really interesting and different one. Maybe it's also just appropriate, maybe just to talk a little bit about some of those challenges, but also from the standpoint of Mercado Pago and what you do, and then what are the kinds of regulatory questions that you face sort of traversing the region.
Perfect. So the trend regarding regulatory issues in the region has been almost the same. There's been 3 very clear stages of regulation. The first one was very related to what I said just some minutes ago about opening competition, allowing more participants to enter in the arena of the financial services, to break these monopolies or oligopolies that we saw in the region, like walking ahead with serving this type of products, and of course, not providing services for the full pyramid of the population. And also,
this is payments, and this is often, payments, or do you see that even moving throughout the ecosystem?
Imagine if payments, which is like the most easy door to open, was the one with problems when you go to credits or investments or, let's say, insurance. The amount of people reaching those type of services was even less. Mm-hmm. So once we have more players in place, the second stage of regulation tried to bring 2 very important things to the field. First, what we call the interoperability between these type of payments, let's say the incumbents and the fintechs and the neobanks now having to interact through rails that connect one to the other. And in this phase, we also saw the erasing of what we call instant payments. So the balances in fintechs and in banks are now available online, real time, 24 hours a day, and basically in some countries at no cost. So this brought like a very, very relevant diminish in the cost of processing payments and entering into this digital arena that tried to capture most of the share that cash was taking. to process payments and do transactions. And the third stage that is starting to appear is what we call the open banking stage, in which we are seeing persons owning their own information, deciding where to drive the principality of the managing of their own financing, with much more competitivity in the type of products they can access, and now being so important to create this delightful experience, this trust and this security awareness that you should provide and bring to the table in order to win the principality and choose of these customers.
Please.
Sorry, no, and in these three stages, of course, we see like two types of players. Players that do not only want to do like the regulatory tech, but wants to bring innovation on top of what regulation brings to the table. And of course, the other type of players that do not want to break the status quo of what's going on.
Do you get a sense that within Latin America, there are any countries that are more advanced, either from a tech perspective or a regulatory perspective when it comes to frontier technologies?
Sure, and we say that Brazil is our way to look and to learn from. It was the country that started first, like this opening of the industry to more players. They are the one that started with Pix. I think Pix was the product that brought like the success case of instant payment, and how Pix won share really, really quickly compared to other means of payments. And now is the country that is leading open banking as a trend in our region as well.
Yeah, that's certainly something that I've heard many times, that Brazil is getting something right, and or at least is garnered more than a couple of fans when it comes to financial technology. It's always good to ask the real experts, just to get your view. Here in the United States, if you read any of our financial press, when it comes to sort of the newest innovations, cryptocurrencies are always sort of, at least currently in our headlines. What kind of space are cryptocurrencies sort of occupying in the larger financial conversation in Latin America? And have you, under your leadership, found them to be, or crypto to be, an interesting space, especially when you think about the opportunities, but also risks facing this large unbanked community?
Huge trend in Latin America as well. We are starting to see this first usage of crypto related to buy, hold, and sell, more related to invest, not yet to pay. But once you start to get into crypto, see its potential, I think that we will see a lot of new use cases arising, let's say on top of remittances, cross-border payments, have a lot of opportunities, not only in the financial space. I think that crypto and blockchain might be the next internet web of disruption looking some years ahead. So we are following this trend really, really close. We did a very small move, turning part of our treasury into crypto. We are holding a small size of our treasury position today just to be and understand how it works. And of course, we see a lot of potential, not only to offer Latin American users these type of solutions, but also to allow users in Latin America to interact in a more efficient way with users all around the world.
Yeah, I find, so last night I was at a serious dinner with some regulators here in the United States. And one of the challenges that one has when you talk about the conversation of inclusion, and we can use the cryptocurrency issue as an example, is that very often you're thinking about new frontier technologies, and yet we're also talking about vulnerable populations. So you have this kind of high risk, high reward trade-off or environment that's not infrequently sort of the case. Or easy to manage. How do people in Latin America, and how do you as a leader in financial services, how do you thread that needle when you're thinking about the opportunity, but also again the complexity of financial technology?
Well, the answer, Chris, is basically how to turn that complexity into simplicity. And basically for us, the quarantine and the very strict quarantines was a proof that if you were able to put simple tools in hands of our users, then you were able to see the type of results that we saw. Perhaps in our region where quarantine was so very strict, people were basically not in the streets at all. And many of these small entrepreneurs and businesses had to reinvent their way of working in a very short period of time. So if we could not provide technology agnostic to the sophistication that they had in order to manage them, then the transformation could not be possible. We made some weeks ago a study with a company called Trendcity all through the region to see not only the needs, but also the struggles regarding financial services of our users, and also the effect that digital wallets and tools had specifically during the pandemic. And we saw that 1 of 4 people started to pay in a digital way because they were not able to manage cash. And 1 of 3 sellers started to sell and incorporate new means of payments to open this way of reaching the audience. Nowadays, 90% of those users say that are selling more than what they sell before the quarantine because of these new technologies that they incorporated. So if we do not turn complexity into simplicity, that cannot work.
I have to say, Paula, that's one of the best answers I think I've ever gotten for that particular question. I mean, what I like about it in part is that it is a simple answer. It may be hard to do, but it's philosophically and strategically a very simple answer to a potentially complex question, and you're sort of demonstrating simplicity while also suggesting it at the same time, and I actually like that a good deal. I guess we'll just end with the last couple of minutes, just sort of thinking strategically about inclusion and technology. You had sort of mentioned how payments and the payment sector, it's sort of like just almost sort of the base level infrastructure for inclusion. And then you sort of went up the sort of value chain in terms of what kinds of services, financial services, individuals may need. Just sort of briefly, as we conclude, are there, even within that ecosystem, even in that priority list, are there technologies that you think are particularly effective and important for advancing inclusion that you've seen in play out in Latin America?
Sure, Chris. And I think I mentioned the pyramid of the population before. Just imagine that pyramid and then a reverse pyramid, the first one showing population, the second one showing the volume that each part of the pyramid moves. So basically what we did was not entering on top, but from the bottom. So that allowed us to reach a very, very huge portion of people that were underserved in the 4 basic pillars: payments, credits, investments, and insurance. I always provide a very good example. When we started, for example, in Argentina, providing investments, there were 400,000 accounts of investments in the whole country during, let's say, the last 50 years. In 2 years, we were capable of opening 4 million of new accounts for people investing an amount of $60. So what I try to say is the way we conceive our company is thinking that our region is full of dreamers that want to make those dreams come true, that wants to move on in lives, but many times do not find the way to start because closed are most of the times closed for them. So being the starting point for many of these dreamers in our region is the way we created everything that we've done during these last 15 years.
That is so fascinating. It's an interesting blueprint. I can't help but just think that that there are some things that are transposable and adaptable elsewhere, and I really do appreciate your time. Thank you so much.
Thank you.
On to, I guess, I'll pass the baton on to our next panel.
Upfront, many kind thanks to Georgetown Law and the BIS for coordinating these sessions. Good day, everyone, from wherever you are in the world. My name is Arif Ismail, and I'm the Deputy Division Chief at the IMF. A warm welcome to the session on CBDCs, a platform for all. Financial inclusion, of course, is one key policy objective for many central banks in considering the issuance of CBDCs. Yet, how CBDC should be designed practically to promote financial inclusion is an open question, right? I'm delighted and privileged today to be in the company of some brilliant minds who have been thinking about this more deeply. We have three beautiful minds. Danelle Dixon is the CEO and Executive Director of the Stellar Development Foundation, a nonprofit organization, of course, using blockchain to unlock the world's economic potential, making money more fluid and people more empowered through open markets. Jessie Lee Maniff is a payments research specialist at the Federal Reserve Bank of Kansas City. Her research focuses on digital currencies and the underlying technologies. Of course, importantly, consumer protection and antitrust concerns in financial services, and most importantly, empirical legal studies. Nanaya Boakche Ajay comes with a rich experience on financial inclusion matters. She's a World Bank secondee to the Financial Stability Institute of the BIS, where she works on a range of projects focused on financial inclusion. Ladies, it's a huge delight. Welcome to the session. Let me jump right in because we only have about 30 minutes and put a few questions to each of you. The first one really is, from your experience, what are the barriers to financial inclusion, and could technology help overcome these barriers? Danelle, let me turn to you first.
Yeah, good morning or good afternoon or good evening, depending on where you are. I'm so honored to be here. The barriers to financial inclusion from my standpoint are really systematic. The current financial system was really built for the few and not for the many. And so I do believe that technology can actually enable the opportunity for the many to be able to get access to some of those tools that are available already to the few. I think that one of the key things to be able to make that happen is really ease of use, security, and that building of trust with the user from the developer standpoint. So it's so important to be able to create and to solve problems for these users that are that from the local standpoint. I frankly think it's very important to really bring the local developer community into these types of this type of technology to help them to really think about the problems that their friends and family and everybody are encountering, and then really leverage the technology to be able to do it. So I think that, you know, when we have this systematic exclusion from the financial system, really using technology and innovation to help to open that access is really important.
Thank you so much. There's some really rich insights that you provided there in terms of built for the few, not for the many. And I like this thought of having people who understand the local environment apply their minds to it. Thank you for that, Danelle. Let me turn to Jesse. What are your thoughts, Jesse? Would you agree with Danelle? Do you have additional thoughts on barriers? And could technology help overcome these barriers?
My work is a little more specific than generic financial inclusion. So I typically look at what we call in the US unbanked households, which are those households that do not have a checking or savings account. And that is 5.4% of US households at the moment. And the FDIC survey of household use of banking and financial services actually looks into some of the details as to why some of these households do actually not have checking or savings accounts.
Right.
First thing we see quite a bit is costs. So 38% list the main reason for not having a checking or savings account as being cost related. So this could be having funds to maintain a minimum balance, thinking fees are too high, thinking fees are too unpredictable. So we find a lot of the problems are associated with costs. The second reason is actually pretty fascinating, and it's that they don't trust banks. And so this is a distinct category from any other possible option, including other, which signals to us that there's something inherent about the unbanked households not trusting banks. That means even if we were to solve for all of these other problems, they still might not be seeking a checking or savings account. Finally, we see a much smaller percentage, I think it's about 7%, that are some of the other issues you hear often about: inconvenient hours, locations, insufficient product offerings. But this is a much smaller percentage as the main reason, than one would suspect. I do agree with how Danelle looks at technology can be a solution, but with the unbanked population, the question becomes, do they have access to such a solution? Because we do have a bit of a digital divide in the US. Of these unbanked households, only 33.8% have internet access compared to 82.6% of banked households. Regarding smartphone access, only 63.7% have it over unbanked households compared to 86.6% of banked households. And finally, these unbanked households are twice as likely to have to cancel their cell phone or smartphone plans because of cost-related issues. And so I do think there is a bit of a digital divide, and getting this, while technology might have a lot of ability to provide some solutions, we do need to close the gap of this divide to be able to get these unbanked households to even be access to these potential solutions.
Fantastic, fantastic. Thank you, Jesse. I think, again, some very deep insights, and the two that you draw out really well is that, we often talk about costs, but you're putting costs at the heart of what the matter is, especially for unbanked households. As you describe it, you're being very specific about this particular segment, and then linked to that, the aspect of trust. So thank you for that. Nana, let me turn to you. What are your thoughts on the matter?
Thanks, Arif, and thank you for having me. Just want to mention, I've been doing some research with colleagues both from the World Bank and the BIS on CBDCs and financial inclusion. We've been interviewing a range of central banks who have advanced thinking on these issues. So we've spoken to the Bahamas, Canada, China, Eastern Caribbean Central Bank, Ghana, the Philippines, Uruguay, Ukraine, and Russia. And there were some really useful insights from those conversations and those interviews, kind of about how they see the barriers to financial inclusion and how technology can kind of potentially address those. So I'll draw on their responses kind of here. And interestingly, many of those kind of mirror what Jesse's saying. A major barrier is high fees, where the cost of financial services are just too high for a significant proportion of people. And this comes in many forms. So, minimum balance requirements, making it really difficult to just maintain your account. Account handling fees, that are really noticeable when you don't have a lot of money, and then just general transaction fees. All of these are making loads of financial services just kind of out of reach for a significant proportion of their populations. Other issues, again, Jesse mentioned trust. I think that kind of goes hand in hand with the issue of kind of a limited understanding as well, lower financial literacy, not knowing how to use financial services, but also not knowing the value that they kind of bring to your individual life. And this was mentioned as a significant barrier, and also surprisingly hard to remedy barrier for many of the countries that we spoke to. Another one that actually I think was raised by every single country was the challenge of physical access. So for most of the countries, they have very remote areas, including islands that are only accessible by boat, or like extremely rural areas with terrible road connections and really bad phone and internet coverage. So these kind of infrastructural challenges can make it really difficult to access a financial service. It can make it difficult to build bank branches, to provide ATMs. And so there's just physically nothing around you to facilitate access to financial services. So these were some of the challenges that the central banks that we spoke to highlighted as real problems. To speak to your question, so can technology help? As of today, I think technology has already helped in really significant ways. You know, if we look at emerging markets, developing countries, and if I'm selfish and I focus on my own country, Ghana, which are also looking at a CBDC, technology has been transformative. Mobile money, you know, basic private e-money delivered for a mobile phone, initially by non-banks, now banks have also jumped in, has completely opened the retail banking market. In the capital, Accra, I don't know if any of you have visited, you'd be hard pressed to find someone that doesn't have a mobile money account on their phone. You can get into an Uber and you can pay with your mobile money. He might not want to take it, that's a different conversation, but he has it and can receive a payment through it. You can buy your fruit and veg with mobile money. It's the fastest growing mobile money market in the world. And that has, and the result of that is that so many more people are included. You know, and critical to that is the exchange of cash and mobile money happening at every aspect or every segment of the city. You know, you can't go 1 meter without finding a mobile money agent. So technology has already transformed access to financial services in a really big way.
Thank you. Thank you. Once again, you kind of point to the importance of cost elements, trust elements, etc. But you add an interesting dimension, Nana. The first dimension I think that you've added is from the demand side and literacy. That is super, super important. And you pointed, and I'd like to come back to this at some point, that it's hard to remedy. Right, if I understood you correctly, and it would be intriguing to kind of unpack that. So maybe in the next round, you could keep that top of mind in terms of what makes it so hard to remedy. But at the same time, you point to, you know, the presence, the availability of mobile money, and you know, the question that comes up in my mind is, well, you know, given these very difficult barriers that you all have described very well, and given the emergence of mobile money, you know, could CBDC actually be a platform for all? And is it a solution looking for a problem? How would you think about it in the context of mobile money? And maybe turning to the second question, what specific design elements then must be built into CBDC if it could be a platform for all? Let me turn to, let me spin it around a bit. Jesse, maybe you first, and then I'll go to Danelle.
Sure. As you know, since I've done a little bit of work on this, I have quite a bit to say on this. I should, at this point, put in the fun disclaimer, these views are my own. They are not representative of the Reserve Bank of Kansas City, the Federal Reserve System, or any of my colleagues. So please don't hold anything I'm about to say against them in the future. But first, to try to figure out whether or not a CBDC is something that is even demanded by unbanked households. Going back to that FDIC study, what's interesting to us is that 3/4 of these households don't even want and have no interest in a banking account. So the first question we would have is, do we think that unbanked households will see a distinction between a regular bank account, a checking and savings account, from a CBDC account? Or to them, is there no distinction? Are these one and the same? In which case, 75% of unbanked households would, turn away from looking at a CBDC. A bigger question we also might have would be, if it's not so much keeping people included in the payment system, is a CBDC something to possibly starve off financial exclusion as the world becomes more and more digital, as both Danelle and Nana were saying that, you're getting more digital payments. The idea is, are CBDC possible to keep those who are already in the financial system from having to exit in the future? And if those two things are kind of accepted, that, okay, there is a possibility for those who are unbanked to want to access a CBDC, there are a bunch of design considerations that I do think kind of line up with some of the barriers to accessing checking and savings accounts at the moment. These options are technology agnostic, so I think they can be designed in a bunch of different ways. The first is something I think we've all mentioned, no minimum balance requirements. Given that 29% of the unbanked households list that as the main reason, that would be the low-hanging fruit of trying to attract them into the financial system. The second would be making it sure that it is accessible and can be transacted 24/7 with little to no cost. That gets at your inconvenient locations and hours. Let's add some of the fee concerns. Another feature would be balancing privacy with BSA and AML. While it is not one of the main features listed, 36% of unbanked households do list privacy as one of their concerns. And I can imagine in a world with the CBDC, this could almost be exacerbated, because if you're not allowing any sort of business to charge a fee for transactions, there could be added concerns that maybe data will be used in an improper way. So I think privacy would be really a big deal for this population if you're trying to attract them to be using this kind of account. Given the digital divide, it's really endpoint access is not going to be just limited to something like a digital wallet or a website. And so it's possible outside of just having, a smartphone app or a web page, there might be the need for brick and mortar stores, there might be the need for smart cards, there might be all of these other means of payment that are outside of just the traditional way you think of mobile money, to try to access those that might not actually have access to the technology to get them into the financial system. This one's a little different. It should, but a CBDC should probably be at par with cash and be convertible with little to no fee. I know one of the things we are worried about oftentimes with unbanked consumers are certain AFS services that are predatory. And so one of the things that you can imagine is if you were, given CBDC and really, live in a cash society or vice versa, you would not want to be creating a predatory industry by not having some sort of kind of guardrail around how cash and CBDC can coexist together. And then finally, given this inherent distrust of banks, it's really important that financial institutions would not be the only entities to support a CBDC.
Thank you. Thank you. Again, a significant number of very important design elements. The last one.
As you said, I've thought about this.
Yes, absolutely, absolutely. Especially the point of having CBDC on par with cash, and making sure there's no predatory kind of behaviors. That's excellent. Danelle, let me turn to you. Do you again, do you see similar kind of design elements to Jesse, or are there additional elements that you see being very close to the to the digital money world?
Yeah, I think it's important for us to think about the system itself and how to operate that system. I think that when you have a CBDC that's running on an open public network, it actually gets to that trust element. A lot of the notion, depending on where folks sit in the world and their feelings about the government having access to their information or control of their data and their money. I think having an open public network where this is available, and on an open public network, when you can, the transactions are immutable and they're public and they're recorded and they can't change. I think that's an important part to be able to build that trust. I also think interoperability is really, really important. So that even if you build a CBDC, for example, on Stellar, the fact that it interoperates across other networks, I think is an important piece of it, because it makes it so that one of the things that you hear about the banking system is that it's antiquated in terms of the way the software works all over the world. And I think one of the important pieces is that when you have interoperability, you have competition to create better and better systems. And I think that's a really important part of making this happen. I do think that, just to get to the point that you raised and also that Nana raised about the idea of education, I think so much of what needs to happen with respect to this, it's just simplicity and ease of use. There obviously table stakes are the need for security, the need for folks to have their privacy, the need to be able to ensure that there's going to continually be competition so that you don't get to that predatory pricing. But I think that the idea about making it simple and easy for the user, one of the things I've learned being in technology for the last 20 years is that it's really important to have in-context notification so that you don't try to educate someone at the outset with lists of information and with pages of detail. What you do is you make it very simple for the user to be able to understand what's happening in context. And I'll be honest to say that I think that to the extent that you know, we're actually just getting into this more and more from the standpoint of blockchain and making it very simple and easy to use and really focusing on that UX design, which I think is crucial to the success of this, because you don't want people to have to spend a ton of time understanding the technology. Because as I say, a lot of times, you know, you and I use HTTPS every day, but we may not know every detail about how it works, and that's okay, as long as we know we can trust the system. And I think the same is true with blockchain technology and CBDCs. As long as it's an easy user interface so that folks can trust the product that they're leveraging, I think it makes it really important. And then finally, I think that one of the things I would love to see is the public sector really engaging with the private sector and leveraging all of this really phenomenal work that the private sector has already been doing in this digital space, and then specifically in blockchain, so that we actually can continue that innovation and increase the public sector's ability to push this information out, leveraging that the private innovation that's already happened. And again, I just get back to the point that I think it's really important to focus on local problem solving with local developers. And you can do that best when you have the public sector engaging with the private sector to really make that happen. So those are the big picture. There's a lot of things that I think that Jesse said that are absolutely relevant here in terms of really getting to meeting the consumer where they are, but then leveraging this technology in a way that's going to help to solve the problems that they're encountering so that we can bring everybody into this financial system.
Yeah, I love this idea of in-context notification and simple and easy user interfaces, almost baked into the design so that, you know, it becomes intuitive and very simple and very easy to understand and follow and so on. But again, your notion of this is that, you know, there may be other, I'll just call it hygiene factors, security, privacy, competition. These should be minimum kind of structural requirements, but these are the important pieces that you think need to have additional time spent on, especially the user interfaces and the intuitiveness of the solution. So thank you for that. But again, you draw out, Danelle, that, you know, understanding the local context and for, you know, both the public and private sector to come together and solve in the local context. This is really, really important. And I could not agree with you more. Let me turn to Nana and for your thoughts on how should the CBDC be designed? What are the key components? Thanks.
To be honest, I think that Jesse and Danelle kind of hit the nail on the head on a lot of the critical things. There's not that much more to add. I guess what I will say is that, you know, digital financial services in the broadest sense have incredible potential. We've seen that. I gave the example of Ghana, it's just one of many, right? Have great potential to address the barriers that perpetuate exclusion. What I think makes CBDC a bit unique, or very unique, is that fundamentally it has government support. And so it's well positioned to address many of the market failures that continue to limit access to and usage of financial service. I think that's the piece that's really, really different about it. So it'll be interesting to see the impact of that over the next 5 years or so. I think critical to it is that the design features need to have inclusion in mind. I think there are a number of motivations for issuing a CBDC, and financial inclusion needs to be a critical motivation if you're trying to address that specific policy challenge. I think for the countries that we spoke to in our research that did have financial inclusion as like a top 3 motivation for doing this, there are a couple of things that came out, and Danelle and Jesse mentioned a few of them, so I'll try not to repeat what they said. But one that came out really clearly, a design feature but also a policy, was simplified due diligence to KYC. Every country we spoke to recognized that some form of simplified due diligence would be required if you wanted people to actually obtain an account. It sounds silly, but if you're talking about an emerging market, developing country context, this is a critical barrier. So ID issues, and you know, they're different in every country, and the way in which they look at SDD and implement it is different. But the concept of SDD was recognized as really important and fundamental across all the countries that we spoke to. I mentioned the issue of physical access as a serious barrier for a lot of the countries as well. So offline functionality kind of off the bat was mentioned as something that was really critical. This kind of meant different things for different countries. So for some, it usually meant operating without the internet, you know, and for instance, with a dedicated payment device or a card. But so for some other jurisdictions, they kind of went further. It also meant operating without electricity, because there isn't any electricity in a lot of these countries, or it's not consistent anyway, or after a natural disaster, for example, where these infrastructure things go down, you want your CBDC to be the kind of way you kickstart the economy in that context. So most jurisdictions highlighted offline functionality in both these forms kind of as a critical design feature to address those physical challenges. Jesse mentioned non-smartphone accounts. It almost seems a little bit counterintuitive when you think of this innovative CBDC to also think about offering them on really basic, like Nokia 3210 feature phones. You can play Snake and, but actually that is kind of what you need to make it accessible, and to not perpetuate further exclusion. For one country in particular, they were really looking at smart cards. And the potential there, because it addressed the issue not just of internet but also of electricity, to offer offline payments. And then again, I think it was Danelle that mentioned this, the simplicity of the consumer interface, I think is so important, but also making sure that it has other features built within it that allows the individual to build on this initial access. Right, so some of the countries we were speaking to were talking about including transaction records that could then be ported to other financial institutions to gain access to other types of financial services like credit, and having the consumer actually own that data and being able to do what they want with it. I think that's critical. And of course, that's a design feature, but there's a policy element that underpins that too. Interoperability was definitely there as well. One thing I'll mention is fee free or low cost was an ambition, I'll say, of many of the countries that we spoke to. I think that, operationalizing that then becomes the question, kind of how do you do that without undermining the business model for some of the private players, especially the smaller ones and the non-banks, who really rely on the fees, the transaction fees, to make their business model work. So those were some of the things. And then of course, everybody discussed the importance of financial education, and sensitizing the public on the value of digital payments to kind of help build their trust in these services. Again, how they did that is still kind of to be discussed. And I think people are still trying to figure out how to do financial education well.
Fantastic. I think we've got about 4 minutes left. And this has already been such a rich and insightful discussion. I've got to ask the question. I wanted to skip it, but I've got to ask the question. Given what each of you have been saying, and in particular Danelle, that you've got these different stakeholders, right? You've got central banks, you've got governments, you've got regulators, but you've also got entrepreneurs in the private sector, including commercial banks. If you could just, within 30 seconds, each of you just talk about what do you think are the primary roles of each of these stakeholders in the CBDC journey, that would be fantastic. Nana, I'm going to start with you again and then do it in a different order.
I wasn't expecting that.
Right.
Okay, no problem. I think all of the groups are really important, obviously. My colleague always says, and we may have heard it already today, that there is no silver bullet to these challenges. And every single stakeholder kind of has a role to play if we really want to kind of see the impact kind of truly felt. I think for central banks, that means that they need to provide a platform and design an architecture that has inclusion in mind. I've said that before, but I think it's really important to restate it. I think inclusion must be a major motivation because CBDC doesn't always look the same depending on what your motivation is. In terms of broader government, I think that they have an important role to play in kind of two areas. One is to provide the supporting infrastructure to help facilitate the use of CBDC. Things like digital ID, and other things, including like basic infrastructure like roads and internet. Although CBDCs are maybe being designed to circumvent these or to deal with this barrier, addressing the supporting infrastructure challenges is important. But in addition to that, I think government payments is a critical piece as well. And looking at how CBDCs can actually distribute government payments is a great catalyst for encouraging usage amongst the general population. And for the private sector, very, very quickly, I'd say that they need to buy into it. And I think that for them to buy into it, they need to understand the medium to long-term benefits of CBDC to their business. And I think there's a role to play in government in communicating that, and for them to kind of think more broadly outside of the short-term benefits. And I think they have a real role to play in innovating. Again, the customer interface, innovating on top of the CBDC, providing additional financial services to this user group as well, and critically designing again with inclusion in mind. Don't just pay lip service to the idea of inclusion, actually design with different segments of the society that are excluded at the forefront of that design. Otherwise, it just doesn't work. And I'll stop there. Thank you.
Thank you. Danelle, 20 seconds, and Jessie, 20 seconds.
Yeah, so I think what's really important is consumers need to demand that we actually provide the services to them in a really simple and user-friendly way. I think governments and the private sector from the commercial standpoint need to really communicate and engage. I think without the communication and engagement, we can't actually get anywhere.
Thank you. Jessie, you have the last word.
Well, for the question of CBDC for potential inclusion, I think the big question is who will the unbanked trust? And depending on who they trust, is that the way you start thinking about what roles all of the players you mentioned would actually play?
Fantastic. I want to thank you sincerely. I think it's been a wonderful discussion, fast-paced, really rich. Back to our hosts. Thank you very much, everyone.
Well, I am looking forward to continuing that great conversation that had preceded us with Reza Fakir, who is the governor of the State Bank of Pakistan. And we're going to continue that conversation and really the theme of today's conference on inclusion by thinking about what inclusion means, both in Pakistan and obviously the technology applications. Thank you so much, sir, for joining us. It's a pleasure really to have you with us on DC FinTech Week.
Hello, Chris. Thank you, first of all, for putting really a fantastic event together. I really have enjoyed listening to some of the sessions at the beginning as well, especially with Kristalina and Agustin.
Well, one of the themes over the course of the last couple of days has been really trying to interrogate certain kinds of terms. And today's obviously our theme is inclusion. And this idea of inclusion, as we've heard before, can mean many different things. And they can mean different things depending on where you live and the circumstances that any particular central bank or market participant faces. From your perch, how do you view this term inclusion? What does it mean for you? What does it mean for Pakistan?
Great question, Chris. Let me first try to address it. What do we mean by inclusion from a conceptual perspective? And then let me turn to how do we think of inclusion from a practical perspective, because we also need to measure and see how we are doing on inclusion. Now, from a conceptual perspective, the way we think of inclusion is, that individuals and businesses have access to need-based financial services such as bank accounts, saving, credit, insurance, with dignity and with fairness. And I want to emphasize these last two phrases, Chris. As, in fact, Kristalina was mentioning in your opening session today, one of the things that we see with FinTech and with inclusion is that it particularly benefits those at the lower strata of the income distribution. And, Chris, Pakistan is a middle income country. The penetration of bank branches is not as high as we would like it to be. But more importantly, from a cultural perspective, bank branch staff typically will not cater very well to individuals that walk into the branches that are from the lower income strata. That is, as a regulator, a difficult challenge because there's a limit to what you can do with regulation. So the part of inclusion, when we put mobile bank accounts into people's phones, I think is going to help with allowing such people to get the banking services that they need. So I want to mention that from a conceptual perspective, Chris, but then moving on to a practical perspective, like many other central banks. We look at access to accounts, and I think that is important, even transaction accounts, because transaction accounts, when you send and receive payments, they create a financial footprint. And in a country like Pakistan, where because of informality, collateral is hard to come by, such a pattern of inflows and outflows, in our view, helps to create a credit history or a pattern that banks and fintechs can then use to provide access. Now, we look at bank accounts like everybody else, but I want to point out something very interesting. According to the World Bank's Findex database, Pakistan's conventional bank account density is low at around 376 deposits per 1,000 of adults. But this is missing one very important piece of the financial landscape of Pakistan, which is the number of mobile money accounts. If you look at the number of mobile money accounts, Pakistan comes in at about 257 per 1,000 adults. And that's very close to the median of other countries of about 267. So when you add the mobile money accounts, you see that our overall penetration increases from about 35% to about 60%. Still, we have a way to go. But the point I wanted to make is that mobile banking is a huge part of the financial inclusion landscape of Pakistan. So this is one way to measure it, Chris. But then at the Central Bank of Pakistan, we also believe in peeling the layer of the onion and going a level deeper and looking at how are we doing on inclusion across different strata of society, across different segments. One segment in particular that's very close to our heart is gender. And Pakistan right now, of the 62% penetration that I mentioned, if you look at complete bank accounts using mobile bank accounts as well as microfinance bank accounts and conventional bank accounts, it comes to 82 million unique bank accounts in Pakistan. Of that, 60 million are men and 20 million are women. So we have a big gap. And so we also collect now statistics on gender disaggregated inclusion. And I wanted to point out, Chris, that Pakistan has launched, the Central Bank of Pakistan has launched a strategy called Banking on Equality, which is a policy designed specifically to reduce the gender gap in financial inclusion. And what we are doing is using our powers as a regulator to at least mandate some improvement in gender indicators in the financial institutions of Pakistan. One component of that is mandatory provision of gender disaggregated data on deposits, on credit, on a whole host of instruments, so we can track our progress a bit better. So in short, we have the conceptual concept of inclusion where across the income strata, people can get financial services with dignity and fairness. And then we have the more practical concept and definition of inclusion, where we are trying not only to measure complete access, including mobile, microfinance, but also gender, and then SME and a few other segments that I did not get to speak about.
That was an extraordinarily useful and very rich conversation. And honestly, even living here in Washington, D.C., there were more than a couple of things that I heard that are obviously of interest even for our audience here. Particularly just as a quick aside, this idea of, well, if you have a bank sort of dependent, or at least a traditionally bank dependent economy, and yet you have a middle income slice, well, how do you get those financial services, modern financial services, to people who are traditionally underserved, and looking at, what are the tools at your fingertips in order to make that happen. Maybe, just to continue that line of thinking, sort of going from the conceptual to a little bit more of the practical, your statistics on mobile penetration, super interesting. How do you view then financial technology itself? I mean, the actual tools, right? And the deployment of those tools. How do you view financial technology as then being an important factor for the promotion of inclusion?
Chris, let me share a statistic with you. I told you that there are 82 million unique bank accounts in Pakistan. There are 186 million mobile subscribers in Pakistan, right? So that's more than double the number of unique bank accounts we have. It also shows you that using mobile, we can push and easily push a lot more on our goal of financial inclusion. Now, 186 million mobile subscribers. We have 103 million 3G or 4G subscribers. And we have 106 million subscribers to broadband internet. So what we are seeing is an explosion in growth of mobile and internet banking, and COVID accelerated it. And if you look at the last 4 years, the average annual growth of mobile phone banking has been about 44%. So our strategy right now on the inclusion agenda is that conventional banks make it very cumbersome for people to open bank accounts. And we have actually given full licenses to 2 fintechs recently, and then 4 more are in the works, all of which are focused in the business of wallets and making it easy for those people, particularly who had a harder time finding a traditional bank to bank. Now, let me also mention something very interesting touching on COVID. We used to have, before COVID, 150,000 daily transactions of digital transfer of funds before COVID. During COVID, to discourage the use of cash, we eliminated all fees for interbank transfers. That number of 150,000 daily transactions within the course of about 6 months went up to 1.1 million transactions. So a 10-fold increase. Wow. And it was just a fascinating controlled experiment to see the impact that the stroke of a pen on one small thing can have on promoting inclusion and access.
Wow, those are really interesting data points. I mean, it would also seem to suggest, or to quantify, what cost means as a matter of friction, for transactions. What kinds of, or what volume of transactions are potentially lost when you have certain kinds of frictions in place. Very fascinating, very, very fascinating data. So if we're going, again, I think where a lot of people, and we, for example, later on in this program today, we're going to transition over time to the U.S. context. And in the U.S. context, we're actually going to go through a bunch of sort of case studies and examples and sort of look through how financial technology can or cannot kind of push or the envelope a bit on the inclusion issue. But do you have any examples of your own? I mean, like if you're going to think concretely about, the deployment, given all the data, given the statistics, and then given obviously the footprint of banks and mobile and technology, a couple of examples as to how you've been able to expand inclusion.
I'm going to give you 3 quick examples.
Even better.
The first is something that we are most excited about, and that is a faster payment system that we are in the midst of introducing in Pakistan, the likes of the ones in the UK, Canada, Australia. The name for this is RAST, and RAST is an Urdu word, and it's short for a phrase we have called Rahe-Rast, which means the correct way, or the straight way, or the most direct way between 2 points. The concept we are trying to convey with this choice of our faster payment system is that we want to encourage people to use digital forms of making payments, to encourage people to come into the formal sector and do it the correct way. And RAST has already gone into operation for bulk to individual payments, and now is going to, within a few months, get to the stage of person-to-person payments. And the alias that we have decided is going to be a cell phone number. I shared with you the number of mobile phone subscribers in Pakistan. And that is going to essentially, if you have a phone number, you can receive a payment and you don't need to remember your bank account. So the first very concrete example that I wanted to mention is our faster payment system, RAST. By the way, I should mention to the participants that at the web page, the homepage of the State Bank of Pakistan, we have a link directly to the work on digital financial services, and you can read more about RAST if you like. The second concrete example of leveraging technology to advance inclusion, Chris, is something that we're really very excited about. In the opening session today, Augustine spoke about the cost of remittances. And you know, Pakistan is a country where this year we're going to get about $30 billion in remittances. There are about 7 to 9 million overseas Pakistanis, and financially, and including for the macro economy, these remittances play a very important role. Because the cost generally is very high, many people end up using informal ways of sending money, hundi, hawala, which is something that we want to discourage, and we want to bring these flows into the official sector. So we launched digital onboarding of the diaspora, an initiative by the name of Roshan digital accounts. Roshan means bright, and the sense we were trying to convey is that our overseas Pakistanis are a source of pride that make the name of our country bright. And Roshan digital account essentially allows overseas Pakistanis to be able to remotely open a bank account in one of the participating banks in Pakistan. We have a central ID database. And with that central identity database called Nadra, we can verify the identity through either a passport or an identity card or a Pakistan origin card. And that allows us to do the full customer due diligence on a customer, and then there is a video interview, and then there can be a wet or a digital signature. Moreover, these accounts cannot be fed by cash, but only by bank transfers. So because it can only be fed by bank transfer, wherever the overseas Pakistani resides, one level of customer due diligence has already been done, because you have to transfer from some bank account. Now this, by making it easy, and we work with the banks to make a turnaround time of 48 hours from the moment somebody completes an application. And we made these accounts repatriable, which means that whenever an overseas Pakistani wants, they can take their money out without getting any permission from the central bank. By making it easy, Chris, we have already, in the 1 year that we launched this, 260,000 such accounts open, and $2.5 billion have already come in through the formal channel through bank transfers, which previously were coming in through other ways. So this use of technology to digitally onboard the diaspora is one area that we are very excited about, to make it easy for overseas Pakistanis to bank in Pakistan and use the formal channels. The last,
can I just jump in there, because just as a question, was there, in terms of building that out, in terms of actually making that system, how much coordination was required for that onboarding with any correspondent banks, or was that something that you could just build out from your side? I'm just thinking about how replicable or not it may be.
Chris, the biggest coordination that was required was with our own commercial banks, because not all commercial banks offer Roshan digital account. And our biggest concern was with cybersecurity and the IT platforms of our commercial banks. So banks had to apply to participate in this program, and we as a regulator did their assessment, not only of their cybersecurity, but also of their practices with regards to AML, CFT, more generally their practices and their track record in terms of our internal supervisory ratings of those banks. That was the bigger coordination. Then the part with the correspondent banks was to negotiate reduced fees of correspondent banks if the transfer was tagged as a Roshan digital account transfer. But Chris, if you give a turnaround time of 48 hours and you hold the soles of the feet of the commercial banks to it, and you make it easy, people come. And our experiment has shown that by making the process easy, Pakistanis are beginning to try it out. And I told you 250,000 accounts, and we have several million overseas Pakistanis. So it's something we're very excited about to reduce the cost of remittances and formalize inflows. But one other point I wanted to mention very quickly is that learning from that, we have now started digital onboarding of customers in Pakistan using remote biometrics. And we worked with the central ID database called NADRA, which has everybody's identity as well as information, to allow remote biometric through mobile apps and other devices. And this is going to allow banks to send mobile teams in urban and rural and peri-urban areas to onboard customers. This is going to allow people to simply download the app of one of the participating banks and open a bank account digitally. It's going to particularly help women, Chris, because in Pakistan, sometimes women don't feel as comfortable or safe going to bank branches, and particularly some of the staff in bank branches might not be as well trained or sensitive to serving women customers in a safe environment and a respectful environment. So this gives them the ability to get onboarded from the privacy of their home or in an environment that they feel comfortable about. So I wanted to illustrate this point that Kristalina was talking about before, about how fintech technology is helping inclusion, but inclusion in a deeper way, where it is helping to reduce the gender gap in financial inclusion.
That was, again, super interesting. One of the most interesting conversations I tend to have from time to time is with a Georgetown alum who's the head of Women's World Finance and microfinance, and talking about women's empowerment, and particularly the issue of controlling and having access to that bank account. Yes, final seconds.
Just one quick plug I wanted to make. This banking on equality strategy that we have for reducing the gender gap in financial inclusion would really encourage your viewers to go to our homepage, State Bank of Pakistan, and you'll see a link on our homepage for banking on equality. Would love to get feedback as well. Thank you.
Will do. And thank you so much for your time. Fascinating discussion, fascinating sets of data. And I look forward to having the conversation again.
Thank you, Chris.
Thank you. On to the next program and the next part of our program and flash presentations.
My name is Heather Hughes. I'm a professor of law at American University. This FinTech Week flash presentation is about how and why to regulate blockchain-enabled financial activity. While many people call on government agencies to regulate blockchain-based markets, my approach is a bit different. I'm concerned with ensuring that emerging platforms get the legal aspects of commercial transactions right from the outset. Markets are poised to involve increasingly blockchain-based smart contracts for decentralized finance, derivatives, and more, and computational contracts for commercial relationships. While the degree to which market actors adopt these technologies remains to be seen, certain regulatory implications of contract automation warrant our attention now. Self-executing transactions can defy legal rules in ways that are difficult to undo. This reality can inject markets with legal uncertainties that beget regulatory challenges. People engaged in contracts coding projects are actively identifying transactions that they determine are well suited to computer logic. But who gets to decide what is codable and what gets coded? Lawyers and lawmakers should participate, not sit on the sideline. as technologists convert legal agreements into computer code. Legal tech companies are jumping in to develop code-based agreements, sometimes with only a rudimentary understanding of the law. Market participants that stand to benefit from legal consequences of automation have no incentive to ensure that the automated versions of their deals confer the same rights on third parties or have the same systemic implications as the traditional versions. The topic of regulation itself often conjures a public-private dynamic in which private actors generate and trade financial claims and public agencies then control for excessive risks. Focusing on a public-private dynamic, however, can obscure the regulatory role of private law doctrines that enable enforceable deals in the first place. Tech companies translating commercial agreements into code may find clear, unambiguous contract provisions that are amenable to automation. But these perfectly clear contract provisions may create highly ambiguous property interests on purpose. The capacity to characterize the interests in assets that a transaction creates is a prerequisite to administering bankruptcy, foreclosure, tax, and other regulations. Purposeful ambiguity in commercial transactions is valuable and efficient. It is not in and of itself a problem. The problem is that the conversation around smart contracts focuses on automation and contract law without considering how blockchain-based transactions can affect third parties in new ways. The term smart contracts here refers to agreements that are self-executing and expressed in code. They are small scripts that achieve functionalities tied to blockchains. They are not contracts as lawyers understand contracts, and they are obscure to a layperson. Smart contracts can integrate with legal contracts that take either plain English or a computational form for the purposes of settlements or other actions. Consider the example of a simple contract in which one party sells assets to another party, and 30 days later, the seller must buy the assets back at a specified price. If an event of default occurs, the original buyer can sell the assets. Coders could express this agreement in computational form. Right? Blockchain-based smart contracts could automate a disposition of assets immediately upon event of default. While the contract provisions here are very clear, what kind of property interest we have is not clear. It is impossible to tell without analyzing the price and other terms whether we have a deal that creates a sale and repurchase obligation or whether we have a secured loan. If this is a sale, then it creates an ownership interest in the buyer, and the disposition on default is not legally problematic. If it is a loan, then it creates a lien in the buyer, and the disposition provisions may violate laws for the commercially reasonable sale of collateral, bankruptcy procedure, and the like. In low-tech deals, upon the event of default, the seller can challenge the deal's characterization, preserving its rights pending a legal determination. In a high-tech automated version of this deal, this opportunity no longer exists. The seller finds itself in the difficult position of contesting a disposition of assets after the fact. Left to their own devices, blockchain-based financial markets may expand despite questionable legal status of constituent assets. Market-dominant transactions with shaky legal foundations present systemic risks. Regulators must deal with the externalities. Lawmakers usually eventually shore up legal foundations by abandoning long-standing rules that had embodied policy choices. A far better strategy is to make sure from the outset that blockchain-based markets are not substituting rigidity for uncertainty in problematic ways. How do we ensure that private law norms persist in blockchain-enabled markets? Perhaps attorneys could be a source of regulatory innovation. For example, the bar could consider it unethical to render a highly qualified characterization opinion for an automated deal. This is just food for thought, intended to incite critical thinking about how technologists are migrating commercial activity onto automated platforms and why lawyers and lawmakers should be at the center of that process. At stake in the legal evolution of fintech-enabled markets is the promise that blockchain technology holds for financial inclusion. Blockchain-based platforms create exciting possibilities for widespread access to capital and to financial services. But from a macro level perspective, left untended, these platforms can foster legal uncertainties that can aggravate systemic risks. Systemic instability, in turn, threatens financial inclusion. As blockchain-based deals proliferate, lawyers, legislators, coders, and businesses need to work together to create markets of the future that rest on coherent legal ground.
Hello, my name is Michał Nowakowski. I am a PhD and legal advisor and also a head of New Tech at NGL Advisory and also a co-founder of C4I, which is responsible for compliance and artificial intelligence. I would like to talk today about the technology and regulation in digital world of finance, which means that the RegTech and SupTech solutions can change the way we use financial services and also how financial institutions and also supervisors are coping with the regulations. So let me begin from the status quo. Currently, the RegTech and SupTech environment is still a little bit immature in terms of adoption by the financial institutional and supervisors. However, significant progress has been done so far. But the thing is that only in a small, let's say, area of the RegTech and SupTech solutions. If we go to the Financial Stability Board documents and also for Bank for International Settlements documents, we can see that the adoption of the SupTech solutions that can be understood as technology that is supporting supervision is at the, let's say, at the beginning of the implementation, so at the moment. So both institutional and supervisors need more effective and personalized solutions to meet the challenges of a growing number of the legal and regulatory requirements. So, for example, in the European Union, many regulations are coming into force or will be adopted soon. For example, we have Digital Operational Resilience Act, NIS2 that is referring to the cybersecurity issues, and also CRD5 and CRR2. So these regulations are aimed at giving more, let's say, requirements or imposing more requirements for the institutions The problem here is that the institutions will have to cope with these regulations in a manner that is effective and will not delay, let's say, or make some impediments for the operational activity of the institutions. So that's why we are looking right now for the solutions that will be able to help institutions to meet this goal or this aim. So, and as a result, the lack of the RegTech and SupTech solutions may lead not only to the compliance risks, which could be quite expensive for the institutions, also for the supervisors, but also for the operational challenges and also reputational risks. This is why also supervisors and regulators should do everything to create an effective framework for the RegTech and SupTech solutions. So the key takeaways from my research are that the rapidly changing environment for digital finance require more decisive actions by policy makers and regulators, and also supervisors, of course. We have seen in digital finance strategy that there are some proposals for creating a framework for the RegTech and SupTech solutions, but still it will take some time to get it done. And also we expect to have some let's say more concrete proposal by the end of 2022. As I said at the beginning, the rapidly changing environment for digital finance that is also creating more challenges for both institutions and supervisors requires more decisive actions by policymakers and regulators. Without that, we won't be able to create a really good and effective framework for RegTech and SupTech solutions. This is why also not only regulators, but also EU and international institutions should pay more attention to that, and also should see pay attention and see more potential in creating this framework for the RegTech tools providers. So from my research, we can see that there's an urgent need for a few things actually to create effective framework for RegTech and SupTech. So the first thing is that we need some kind of introduction of standards for creating regulations so that they can be more easily read by machines, let's say, or algorithms, and proceed into specific obligations of institutions. This is the issue of the machine readable regulations. It was also mentioned in the digital finance strategy by the European Commission, and we are expecting to have some types of the regulations for the financial sector made in this format by the end of 2024. But I think that we should also consider moving more broadly with these machine readable regulations. Especially that we are considering Open Data Directive and the implementation of this Open Data Directive. The next step that should be done is opening data and the wider adoption of access interfaces, APIs, also for supervisors and institutions. When we think about the SupTech solutions, we think about real-time supervision. Real-time supervision might be a good way to have more effective supervision, but it needs APIs because the supervisor and also institutions should be connected to get data in the real time. Third thing is the education on the availability of RegTech and SupTech tools. From my research, it is clear that institutions are not aware about solutions that are available at the market. So that's why we should also make some kind of marketing campaigns or something like that to inform that there are some solutions that may help you with coping with the regulatory requirements. Next thing is the creation of a transparent framework for providers and institutions, including outsourcing. EBA, the European Banking Authority, has mentioned in one of its reports that the adoption of RegTech solutions is sometimes impeded by the outsourcing requirements. This is why financial institutions are a little bit afraid of entering into outsourcing agreements with, let's say, immature RegTech providers. So we should think about some kind of, I don't know, like guidance or recommendations for the outsourcing for this particular part of let's say, fintech. What is also really important is the certification, some kind of certification for the RegTech and SupTech providers, because right now, as I mentioned, some financial institutions are a little bit afraid of this immature RegTech startups, let's say, startup providers. So if you would have a clear framework for the certification that will be also supervised by a relevant authority, it might help with the broader adoption of the RegTech solutions. And also, as I mentioned, also this loosening outsourcing requirements and potential insurance or relevant guidance might support the wider adoption of the RegTech and SupTech, of course. What is quite important is that artificial intelligence, let's say machine learning, deep learning, and natural language processing will play an important role in developing RegTech and SupTech solutions. Right now, we are aware that the data is the most important thing, and the data analytics will give a lead, let's say, for the innovation within the financial sector. So the so-called artificial intelligence is creating many opportunities for the automation and of course, prediction and decision-making, and also is increasing a lot, increasing effectivity of RegTech and SupTech solutions, and also financial institution operations itself. So in parallel, it may create new risks for example, for algorithmic bias, discrimination practices, manipulation, and ethical issues. This is why it is also important to consider some ethical issues when drafting, let's say, the framework for the RegTech and SupTech solutions. So therefore, lawmakers and regulators should pay attention to how institutions are using AI. For example, BaFin, the German supervisor for financial services, has recently adopted principles for algorithms within the financial sector. There is a great research about the adoption of the AI within the financial sector, and I think that this is necessary. This is and also quite important to have it also for the RegTech and SupTech solutions. So as a result, policymakers and supervisors or regulators should consider making ethical codes and good practices for RegTech and SupTech solutions. It may also be supported by relevant sectoral, let's say, organizations. This is why we also should consider sectoral guidance or recommendations that may help institutions to adopt such solutions, not only, of course, RegTech and SupTech, but AI in general. But as a consequence, this might and probably will create some new challenges for supervisors that should be addressed as soon as possible, because wider adoption of AI will require supervisors to have relevant resources, also people and competences to make effective supervision for that. So as a conclusion, I would like to say that RegTech and SupTech will change the landscape, and this is not only the way to cope with the regulations, but also this is the way to make institutions more effective, especially when we have to, as financial institutions, to cope with upcoming regulations, upcoming challenges that are tied to the digital world. We have so many cybersecurity threats, and this is why we should make it as soon as possible and not waiting for anything. So thank you so much, and I hope you will be you will have occasion to read the whole paper about the RegTech and SubTech in the digital world of finance. Thank you so much.
So I am absolutely delighted to have Kimberly Johnson now here to join us. Among other things, I have the pleasure of being on the board of directors of Fannie Mae, and I always have very regularly the opportunity to listen to Kimberly talk about technology, financial inclusion, and really all aspects of the company. She's more than a rising star. She is a star now in not only housing circles, but also in financial circles. And to have her here, the Chief Operating Officer of Fannie Mae, is a pleasure and a delight. Kimberly, thanks so much for joining us for DC FinTech Week.
Excellent, Chris. Thank you for having me. I'm excited to be able to participate.
Okay, so when you hear a company like Fannie Mae, I doubt that very many people, and certainly I hadn't at first really thought of it as a kind of a technology company, but you don't really think about technology and Fannie Mae, despite its size and its importance to the U.S. economy. I'd just like to get your perspective and your take. Like, what does technology mean to Fannie Mae? What does technology mean to you?
Awesome. Thank you, Chris, for asking that question, because we have been around for quite some time, and technology is a really important part of what we do at Fannie Mae. We are definitely no stranger to innovation, right? When you think about fintech, you think innovation. Back in 1995, we created the desktop underwriter, and that was one of the industry's first automated underwriting systems, and it allows us to really operate at scale, and it's still a leading engine for underwriting within the industry. So again, thinking back to the 1995 time when we launched Desktop Underwriter, so much has changed in mortgage, right? Like, I don't know if you've gotten a mortgage anytime recently, but you used to have to pull files and get documents and fax them and scan them, and it was resending, and it was a really onerous process. Well, today's folks are making decisions faster, they're doing things digitally, and they want their mortgage process to be just as fast and just as digital. And we see the pandemic accelerating adoption of all kinds of digital tools. We see people doing lots of things remotely, from application to appraisal to closing, that would have never happened at this rate of speed and adoption if we hadn't gone through this opportunity for people to learn how to do things in a remote way. So it's really interesting. The digital tools are one thing that helps. But when I think about this sort of technology and how this really pertains to fintech, so much of what we're doing is really also around data. We really think about how data can change not just housing, but also the housing finance industry and the experiences that our borrowers are having. So again, just to give you a little bit of background, we use data and analytics to really transform our business. I'm remembering all the way back to the housing industry. We had really few front-end controls. We set the parameters for the kind of mortgages that we would want, and then people would deliver them. And after the loans were delivered, we'd spend some time pulling the data and doing some audits and running the quality checks. Well, what we learned through the crisis is that's not really an effective, efficient way to manage our risk profile. We've actually changed it now so that we can validate data upfront at the time the loan's getting underwritten. And it has really changed our entire risk equation. And it's removed a big pain point for lenders and improved the quality of our loans.
Well, for those also, and maybe I should have prefaced this for those around the world. In the United States, Fannie Mae is one of the few companies where you actually don't have to really explain very much to people, precisely because of its sort of centrality to the U.S. economy. But for those, because we do have so many folks listening from around the world, Fannie is really one of the key institutions undergirding our housing market and the mortgage market. And it is pretty funny when you had said, well, I don't know if you've done a loan application anytime soon and all the paper. I'm old enough to be to be someone who was fortunate, to buy property when Washington D.C. was only extraordinarily expensive as opposed to completely unaffordable, and there were enormous amounts of paperwork. One of the things that I think is kind of interesting, and I know we're going to get to it, by definition, but when you talk about Fannie, you have to get into it soon. Is writing a mortgage, even buying a house, is usually considered to be a kind of a middle class rite of passage and opportunity, at the same time. But the question is, to what degree do those processes and those written down, pull out files processes, to what degree does that sort of contribute to larger kinds of questions about inclusion? And so one of the things I think that you're trying to get at is automation, but then there's the second issue, an allied issue of inclusion. And maybe if you could just sort of thread that needle for us as to, okay, we're thinking about the middle class family. What does this mean for economic opportunity?
Right. No, it's really good because you wouldn't think automation and inclusion necessarily go hand in hand, but we found that there's a real opportunity to do exactly that. Right. I will use the crisis that we just went through around COVID as a good example. So back in March, April of 2020, we started to see unemployment spike at a really fast clip. I think it hit somewhere close to 14% in the early days of the pandemic. And those of us at Fannie Mae were starting to get a little concerned because going back to the housing crisis that we saw in 2008, when we see unemployment spike, that usually means that people start missing their housing payments. And what was really an opportunity for us was to look at how we might be able to put solutions in the market to help people actually stay in their houses through a time when they couldn't make their payments. And we established a forbearance program, and we were able to get our borrowers educated about it and adopting it and putting it in place in literally a matter of weeks. And if we hadn't been using technology to update our systems, to get on the cloud, to have different streaming data platforms, none of that would have been able to happen with days to solutions and weeks to adoption. It would have taken months to put those solutions in place. And that would have meant that people were at risk of actually losing their homes. And when we think about automation and inclusion, it's not just getting in the home that matters, it's staying in the home that matters. We have to make sure that we make housing choices available to everybody, but part of that is making sure that when you make those choices, that you have a sustainable home ownership opportunity. So I think that we just went through a really fascinating case study on why having good automated processes and really terrific technology infrastructure can help bring solutions to people that need them at the time that they need it, in a way that really just makes sure that housing is available at the times we need it most.
Yeah, the United States is interesting both in terms of the history of housing. It remains probably the primary ladder for wealth creation, the primary wealth generating mechanism for most Americans. You go and you buy your house, and over time you can own it. The history of housing in the United States is a bit more checkered, from redlining and racial discrimination and the lack of opportunities in order to purchase homes, to really now the challenge of wealth and income inequality, and that I think creates considerable barriers when it comes to accessing the American dream of buying a home. And one thing that I guess I've been able to see you do and to help have a lot of leadership in is rethinking and deploying data in the rental space. Could you maybe sort of talk about that? And I guess another use case or another application of technology when it comes to inclusion in the U.S. context.
Oh, that's a really terrific opportunity to talk about something we're really excited about at Fannie Mae. So you're right, Chris. There has been a little bit of a history of racial discrimination in housing, and it's really been through the policies that exist and the way that those policies are enacted. And one of the things that we recognized is that buying a home requires having a credit history, and credit histories are built in lots of different ways. but they're not built by everyone exactly the same way. Lots of people who buy houses have parents who co-sign. They have student loans that they pay down. They've got credit card debt. And all of that builds a history that allows them to prove that they're a responsible credit borrower and they should be able to get a mortgage. Well, and you look at some of our communities of color and the sort of underrepresented minorities, there's not a lot of parents co-signing on loans or big credit lines that are being given out and paid back over time, or even necessarily college tuitions to get your student loan payments documented as having a good payment history. And so the one thing a lot of people are doing, though, no matter what community they're from, is paying their rent. And we're big believers that if you pay your rent on time, you probably are going to be likely to pay your mortgage payment on time, particularly if it's in the same range. And so rental payments are not actually included in the FICO scores and the credit histories that people build. They haven't been up until now, at least. So at Fannie Mae, we've been working for years on putting together the right data structure and collecting that data to make sure that the property managers and landlords and those who are actually doing that can submit that data to us in a way that allows us to see the consistency over time. I think that's going to be a really big factor. But we've done some very interesting innovations that lets borrowers opt to have us do a verification of their assets. We can look at their banking data and we can actually see if payments that match their rental payments that they've been making, that rental payment amount, are being made consistently over time. And we've got really smart technology that uses some great scanning and AI tools. It doesn't matter if you're paying someone else. It doesn't matter if you're splitting up your payments, if you're not paying at the same time every month. You could be paying through PayPal or Zelle or Venmo or Square. You could be writing checks. You could be going directly into your landlord's payment portal. There's lots of ways we can pick it all up and see that you're consistently making payments that match the amount of your rent, and we can give you credit for being a really good payer that doesn't show up anywhere else. And that positive boost to your credit application is something that we think is really going to open doors for folks who otherwise wouldn't have had a chance to build their credit history.
Yeah, I will admittedly say I am just thrilled and delighted and super excited. When you see a company the size of Fannie Mae really thinking seriously about alternative data and to think about, well, what are the existing tools like FICO and are there ways to either improve upon or to supplement those tools in ways that are a bit more equitable. And I think a lot of people sort of think that that's just purely a policy question when there's a lot of technology that goes into that. It's not like you just sort of flip a switch and say, okay, we're going to have more data, so it'll be more inclusive. You actually kind of have to build a system and a strategy to capture that data. And I only say this because in the U.S. context, once in a while you hear, oh, there's nothing been more sort of useful in fintech since the ATM. I'm like, that just can't be right. That there are some pretty interesting things that are happening, and that can have a real impact on people of color, frankly, in the States, and rental data, collecting rental data. Nobody wants to be homeless. Whether or not you're paying your rent or you're paying your mortgage, it seems to be a pretty good factor. I did want to pick up on a couple of things that you just sort of mentioned very, very briefly at the end of your comments, in part because we're going to have a conversation towards the end of the day on MDIs, CDFIs. We're going to have the chairman of the FDIC, the acting comptroller of their currency, sort of talking about sort of the tools to help to enable community banks and minority banks to sort of scale and to grow. You were talking about towards the end something a little bit more than just alt data, right? Because you're talking about being able to peer into different kinds of transaction accounts and the like. Just to sort of follow up on that briefly, what kinds of other technology tools then are you really sort of excited about in terms of cracking this problem of housing affordability that's obviously front and center in the nation's conversation that, from your perch, just seem pretty interesting to you?
No, I think that's a really good question. And there's two pieces to that I would want to tackle for a moment, because you're right, we've got to talk about the tools that are available. It's not just policy, it is some tooling, some technology. But sometimes we can use those tools to actually identify the problems that we want to go after so that we can make the right solutions. And I'll just give you a really quick example, right? Like we used our National Housing Survey, and what we found was that Black consumers actually identify an insufficient credit score as the single biggest obstacle to getting a mortgage. And 29% of Black consumers are worried about credit score as a reason they won't be able to get a house. And so just having the ability to go out and to scan the environment, to find those folks, to digitally give them an option to participate in our surveys, to collect that data back, to analyze it, understand it, and that starts the beginning of, okay, so what kind of solutions do we want to create? So I can't say enough, data collection, really, really important. When we talk about who has credit and history and who doesn't, 20% of the US population does not have an established credit history. This isn't a small problem. Like this that we're talking about isn't going to solve things on the margin. 20% of the US population, and people of color are disproportionately represented among the 20%. So I think this is going to be something meaningful. And when we look at the data just that comes through our own automated underwriting system, of the folks who aren't successful in getting their loan applications approved, just looking at the rental payment history and understanding who has made really consistent payments over time, that would actually get 17% of those who were unsuccessfully submitted their applications to be approved if we use that data. So again, I just wanted to start by saying, yes, framing the problem and understanding what to go after is hugely important, and knowing that the things that we are using these solutions for is going to be impactful in its delivery is really, really important. And when you think about the tools, again, some of them are new and exciting, right? I heard one of the speakers before me talking about blockchain, and there's lots of questions about whether or not blockchain has a place in housing, particularly around some of the things that should be able to be stored in a data secure way over time for better access to understanding those facts and particular characteristics, things like title, for example. But there's some really basic things that we find, like just having APIs to exchange that important data back and forth between the industries is really important. Having the right data platforms to be able to ingest all of that data and analyze it right. Like there's some basic things the industry can do before we get all the way to blockchain, before that really helps us with the solutions that we're putting out.
I find that really, really instructive. I mean, if there's one thing I've heard recently, and again, today we just released a big report on MDIs. You can go to dcfintechweek.org, selfish plug, in order to sort of see that report. But the API issue, APIs is really something. It's almost its own kind of infrastructure plan that's needed, just in terms of onboarding new kinds of tools and technologies. We only have a couple of minutes left, but you've been you've been very involved in the digital transformation of Fannie Mae, and it is hard to emphasize if you haven't seen it. That's a job. I mean, that's a real job. It's a really important job. And just sort of moving that architecture around to the cloud and elsewhere has been has been a focus of a lot of your time. If you could just in a soundbite sort of, say what's, looking back, what does digital transformation mean for you? And then maybe looking forward, are there any other interesting tidbits or nuggets that you're thinking about over at Fannie Mae?
That's a terrific question, and a tough one too, because it is just so big, right? Like digital transformation has come to be like everything technology, which has come to underpin everything business. So it's hard to pin down, but I think for us, we recognized early on that as one of the most important intermediaries in the entire housing ecosystem, right? We have a responsibility to make sure that we're safe, we're sound, we're secure, we're resilient. And so our digital transformation began with a real interest in making sure that we have the right platforms underlying the industry. So it was all around modernizing and updating the infrastructure itself. And much like everything we've talked about today, what we've become, what we've learned over time as we've done this is that that's really just an enablement for the data that flows through, the decisions that can get made, and the business that you can do based off of that great infrastructure. So I would say for us, we've figured out that if we can make our decisions faster, if we can streamline process, if we can automate more, we can take unnecessary cost and fees and all of the sort of intermediary administration of getting mortgages in the hands of borrowers. That makes it faster, it makes it cheaper, it makes an easier, better experience. And so it's all around improvement that makes access, availability, and inclusion a little bit closer for everybody who's out there.
And I will use that then as also the preview of things go faster, better. Now, Kimberly, I want to say thank you so very much. As I said, it's a pleasure watching you up close and afar, and I really appreciate you taking the time to join this year's FinTech Week.
I loved it. It's a terrific week, and thanks for hosting it.
All right, so we are now going to go to our all-star next panel with Maria Adamji and others on social fintech. But we'll be moving on to this next part of our program now.
Thanks so much, Chris. And I appreciate everyone who's joining us for DC FinTech Week and attending our panel. Today's topic is extending the big topic that Chris just covered about inclusion. We're talking to VCs and investors on our panel today on social fintech. Fintech innovation works to address economic inequities in our country and more specifically across our financial services sector. Joining us, we have two founders and also two investors on both sides of the spectrum here, talking to us about how it works, how the process goes for raising capital, and why this is such a big topic. I'm going to do a quick round of hellos. Please wave, panelists. We have Jimmy Chen, founder and CEO of Propel. We have Jennifer Spalding, who's founder and CEO of Free Will. Kabir Kumar, who's with Flourish, an evergreen fund. And Amayas Goretsky is a partner at QED Investors. So Jenny, let's just delve right into this big topic. What is social fintech and why does it matter?
Well, I'm going to kick us off with potentially a controversial answer to that, which
I love it.
Which is there are lots of different ways to define it. And I think as we've seen in the industry, almost anyone can name themselves a social fintech. But to me, in order to really be a social fintech, your business model, as in how you make every revenue dollar, has to come from an underlying mission that serves some sort of underserved community and makes that sort of impact. And that's a little bit different from, using impact as a marketing tool or a cost line as a CSR piece, which is awesome for the companies that do that. But I do think that there is a difference there. So for example, taking it outside of fintech, if you are making gas-powered vehicles and you're donating part of it to battle climate change, or you're making electric-powered vehicles, I think those two things are actually different things. And I think that could be applied to fintech too.
Got it. And so I guess, Kabir, we'll just let you respond there. I guess when you're thinking of kind of an investment thesis, how do you differentiate fintechs that are socially driven to, financial services companies that just have kind of a more of a social credence? Because those two things are differentiated based off of Jenny's comments.
Jenny, by the way, I love that. I totally agree with you. And in fact, we invest in companies that are directly trying to address these challenges. You heard Kimberly Johnson earlier talking about, the access to credit, and there are 60 million Americans who don't have credit scores or appropriate credit scores. We want companies that are trying to fix that. And in fact, in our case, we put out a set of principles. We call them Fair Finance Principles. It's not a marketing tool, Jenny. It's basically to tell the startup CEOs and founders out there, this is what we believe in. This is our vision of the world. We want it to be more fair. We want it to have these elements, and come to us because we want to work with you and we want to make it happen. So I love that, Jenny, and thanks for bringing that up.
I think also, Kabir, if we'll just kind of press on that a little bit more, you talked to me earlier about the pillars, the foundational pieces that kind of drives Flourish to point at and start kind of investigating these types of startups that are really, really focused on this mission. Can you talk to us a little about those pillars, and how do you kind of get that message across so founders are aware of what they need to kind of focus on and how they need to align themselves in order to get your attention?
Yeah, I mean, it's driven by these principles. They're not necessarily like, the way we assess every investment, but it definitely plays a big part in how we look at the entire landscape. And it's, if you look at those principles, it's, are we solving a real problem in people's lives? Are we smart about regulation? Are we smart about data? All of those are elements of those principles. And so, it's against those principles that we look at businesses. And as a result of that, we've ended up investing in companies like Propel, it's on this panel, or like Chime, like Alloy, and they adhere to those principles. Chime offers the cheapest checking account in the country, and it's ended up being a very good business, as all of you know. And it's not only the cheapest checking account, it's also an account that has no overdraft and no gotcha fees. I think it's 7 to 8%. JP Morgan's profits are overdraft fees, coming from overdraft fees. So you have the existing financial system that's just not working. Chime is fixing that, and it's reaching low-income customers. Majority of them, Chime uses are low-income customers. So that's the kind of lens we use, and those are the kinds of companies we end up working with.
And I would say that the sector is quite big, right? Because there's a huge population that is like underserved. And, I said this previously, that when you're looking at your investment thesis, you kind of look at things in a pyramid. And often it's really, really easy to target the top of the pyramid, which is kind of very obvious use cases that are served already by traditional financial services. And I think there's like this whole fat part of the bottom pyramid that is highly underserved, and there's big opportunities there. And so, Jimmy, looking at you, how did you kind of frame what you're doing today to target that large part of the population that is underserved and, just kind of overlooked, as it were?
Well, I think there's lots of different ways you can start a company. Whether it's based on a new business insight you had, or some market research, or a new technology. In our case at Propel, we really started the company with a focus on a specific type of consumer in the United States. For us, it was someone who was using the safety net, using programs like SNAP, also known as food stamps. And so we really started first with the consumer and started to learn more about her challenges and about what her day-to-day experience was like using safety net benefits and managing finances, and then saw opportunities there to build software that would try to address some of those. And so, I personally didn't quite think of it as, starting from the bottom of the pyramid or anything else like that. It was just a much more personal. There are 40 million Americans who get SNAP benefits, and that's a lot of humans. And there's a lot of human pain when those services don't work well, or when there are opportunities to improve them. And so why don't we just start from that and, see what kind of product we can build.
And that's really clear. And I guess, Amaya, is looking at you, what is kind of the investor's perspective when you're looking at, really, really passionate founders like Jimmy and Jenny, who have kind of identified a specific use case based off of their experience? There's always this kind of notion of an investment gap in this space, right? Whether it's because of maybe a misunderstanding of kind of what the business objectives are, or perhaps, there's just a lack of, motivation to take a risk there. I guess talk to me about what your perception is, and what is QED's outlook in this space?
I would first draw a distinction between two types of impact businesses, and I think Jenny and Jimmy actually sort of illustrate these a little bit. So one kind of business is sort of, or maybe me and Kabir first, right? The Flourish mantra is contingent on having a mission and having an impact orientation. Is this a great business? And I think at QED, we don't have that kind of overriding filter of mission alignment first, but we also find a huge number of businesses that are great businesses because of their opportunity for impact. I think separately, and this is where I think Jimmy and Jenny have slightly different business models and some of the sort of traps or challenges in this space is, Jimmy's business model is focused on a population with intense need, but also intense financial stress. And so any business model that extracts payment from serving those individuals, which ultimately has to happen, right? If you're providing service, if you're going to be in a business and not a nonprofit, you have to find some way to extract, value to the business side. That is where you really have to rely on the kinds of principles that Kabir and Flourish and Jimmy have worked hard to put in place to have non-extractive, aligned value creation. And I think on the other hand, if you think about the way free will operates, Jenny fundamentally is getting paid by nonprofits. And so the level of financial stress that exists in nonprofits, some nonprofits are doing quite well, some are doing less well. Just this morning, Chris maybe last week, Jenny back on the feed talking about the COVID stresses in the nonprofit sector. But I think, just categorically, the kinds of financial stress that Jimmy's customers face and the kind of financial challenges that a nonprofit face are really a different category entirely. And I think, so with Jenny's business model, the real question is this a big enough market? Assuming that we can have a good economic arrangement. And I think with Jimmy's market, it's clearly a big enough market, but can you serve that market in a way that ultimately is fair and aligned over time? And I think, when we're looking at these markets, those are the questions that we're asking. Sometimes you're in a relatively smaller market like nonprofit software. Sometimes you're in a big market with huge numbers of humans, but you have to ask really tough questions because just having good intentions is not enough to make a great aligned business model over time.
That's fair. And I guess I'll look at you, Jenny, first. What are some of the challenges you faced when answering those questions?
Yeah, there are two sides to the same coin of serving an underserved market, no matter how you define it. So one thing we've talked about is, serving folks who have acute financial needs. That is one underserved market. Another underserved market are serving baby boomers. Relative to millennials, they are way underserved by technology. Another underserved market, and one that we look at, is nonprofits. Relative to any for-profit business, nonprofits provide a third of the jobs in the US, and they have a way, way, way less investment in tech. Why? They can't pay for it. They can't hire the fancy designers and engineers, et cetera. So I think to be an impact business, you can pick what underserved market to go after, but there's a positive and negative in it. The positive is, you're creating a big impact because their opportunity, their other thing that they would do is pretty bad. So that is an advantage. Another thing is that there are way fewer people, definitionally, way fewer competitors that you're going to go into in your space. So there's a lot of room to innovate. But the flip side of that is there's a reason why it's underserved in a pretty efficient capitalist society. And it's because it's hard to find like a really good business model or a big enough market, to Amias's point, in order to really serve those markets well. But if you can do it, it is awesome because you're kind of flying solo and able to do a lot of really cool stuff for that community that you're serving.
Kabir?
Yeah, I was going to say that I don't think just because you are serving nonprofits, because when we say nonprofits, what comes in people's minds is these are customers that are going to pay a lot, but just because you're serving nonprofits, it doesn't mean prima facie it's not going to be a good business. And I think, we are early stage investors. And I think at that stage, when so much is unknown, so much is not fully graspable, we are looking at very few things that are meaningful. One is the passion of the entrepreneur, value alignment, The other is it truly, as Jimmy and Jenny were saying, truly a large opportunity? It's a big space. And then it's a journey. Then we got to crack it, and sometimes we do it and sometimes we don't. And clearly when you are in spaces where others are not in and there are no proof points, it's harder, right? It's a harder journey. And I think in the social space, you often find that more, but that doesn't mean it's not a journey we can all complete together.
And I guess for, Kabir or Amayas, because there are no proof points, because there's no kind of, framework that you can say, this is the trajectory I expect for, someone in the space. How do you make your considerations? What do people do to stand out? Because there's no clear comps.
So I think that there are, generally speaking, lots of Me Too businesses, but most of the time, especially when you're investing in the early stage, there's a pretty large degree of comfort with lack of comps. And so there are a variety of things. I mean, Kabir talked about your passion, alignment, conviction, insight. I think the way I think about it is there an insight at the core of the business that makes something that would be hard for someone else easy for you? Sometimes that's a technical breakthrough. Some of our companies really do have world-class machine learning specialists who can, do privacy protective machine learning. That's just technically difficult. There aren't that many teams in the world who can do it. Sometimes, as with Jenny's business, you have a really interesting insight about turning two unmet needs into a great business. So the lack of truly free estate planning and the underserved nonprofit software sector. So combining those to create a flywheel. And by the time we invested in Jenny, we didn't have the opportunity to invest at the seed, but by the time we invested, the flywheel was already working. So the growth, the hiring, the financial margins, all those things were just clearly working in our favor. And so I think that the lack of a comp really wasn't an issue because we knew that there was a real innovation on the insight side and some real proof points. And that was already true by the time we invested in Jenny, and Patrick had only been operating for about 2 years. So those proof points can come pretty early for people who are willing to take a risk. We don't need to see, 5 years of track record before we start to believe when you have those two things underneath.
Yeah, and I would add, Maria, if I can jump in, it was similar. Jimmy, you should say more about this, but this sort of perspective that Propel had, that the interface with government is broken. It doesn't work as well. It disproportionately impacts people who have less money. If I can address that interface, if I can make that work better, then I can be part of their journey for a long time. And I think that's a very powerful insight. That was what was exciting about Propel. And Propel has been able to act on that and get to the point that they are. Now, Jimmy, you should say more about that. I should also add, Maria, to your point, or Amas, I think, was saying, we have these principles that we put out. Actually, one of the principles around how data is handled was directly inspired by what Jimmy was doing at Propel. He preemptively came up with these principles and says, look, these are vulnerable populations. I'm going to be making a business serving this population. I don't want to exploit their data. And I'm going to, be very careful about how I manage their data. And that was a big inspiration for us to make that a broad principle for all the companies we work with. I'm putting words in Jimmy's mouth, but hoping to get them.
Jimmy, I think everyone's itching to hear kind of your experiences, because it sounds like, the way you positioned yourself was really, really clear. So much so that you actually impacted your investor to kind of broadly, think about their entire portfolio. Please share.
Well, credit where credit's due. I think Flourish approached this space with a desire to come up with something that was really aligned with the ways that companies like Propel were trying to do business, and that we were just happened to be early enough and approach them at the point in the conversation where we were able to have a really open and constructive dialogue about what are the boundaries that we ought to put on stuff like this. I think Back to kind of what Amias was talking about in terms of like how you get confidence to invest in early stage social businesses, whether you need a comp or whether you need, what kind of confidence or what you might look for. I think in my experience, like my advice to any early stage social entrepreneurs is that in the early days, before you have real traction that you can fundraise on, to find investors who deeply understand the problems that you're solving. And I say that as an entrepreneur who is building consumer software for people on food stamps. There are not a lot of investors who deeply understood that challenge. And so we really struggled in the early days of the company to find investors who could reach the level of conviction that they needed to get to write us a check. And I say this not to be critical of investors or to paint them as like totally out of touch people, although some of them are, not these two on the panel, but the other ones. I just think investors are human after all. Like it's very difficult to get to the level of conviction you need to get to invest lots of money if you don't understand a space well. And as an entrepreneur, I'm not going to teach an individual investor about a space that they're like wholly unfamiliar with. And so I think, the obvious corollary is if there are more investors out there who understand a more diverse set of challenges that are consistent with what Americans face, which are not just the financial challenges that a VC investor might personally face, then we will be able to fund more organizations that solve a different swath of problems.
Yeah, I think this is such a good point, and especially for aspiring founders out there. We have a saying inside QED, which I attribute to my partner, Matt Burton, which is, you can't convince anyone of anything. So when you are out there on your founder's journey and you're looking for investors, you're really not trying to convince people to invest in you as much as you're trying to search for people who already have conviction. Now, it doesn't mean necessarily about your business model, but it's about the problems the way you understand them. And sometimes you can create insights by articulating a problem in a new way. But in general, if someone doesn't really understand the world the way you understand it, founders should just go on to the next phone call. And one of the nice things about the market we're in right now, especially around fintech, is there's so much excitement around fintech. It's by far the largest number of unicorn valued companies of any sector. So there's a ton of money that is really interested in dynamic and innovative businesses. So I think the opportunity set is quite large, but you do have to get used to the idea that you're going to run into a lot of people, especially if you're in the social space, especially if you're serving an underserved group, who just will be confused as to why you've got the conviction that you do. And my advice is always just keep moving. You can always improve your story, but you probably, the story isn't what's going to do it. It's the underlying conviction and then finding partners along that journey.
So I want to double click on that point because I think we are often, when we think about investing, we're always thinking about founders who are looking for investors and they're just kind of knocking on doors. And that is like the picture that is portrayed, in shows like Silicon Valley. But I think the reality is it's two-way, right? It has to be like a bilateral relationship. There has to be a right fit, right? So it's not just kind of going out there and talking to as many investors as possible. It's finding the right investors with the right alignment and a true understanding of your vision and the market. Jenny, I want to look at you because you said something really interesting when we were catching up last week that, you have to also be very clear about your business model, right? So you can't just be so focused on, your social credence that you just kind of have your business model be very, very objective, right? So there has to be kind of two sides to your story, where you have like your definition, your mission statement, and then how you're going to do that, and then also like, how am I going to turn this into a business? Talk to me a little bit more about how you like bifurcated those two things and then created a company around.
Yeah, I'm sure Jimmy has thoughts on this too. But we talked a little bit about incentive alignment, right? How can you make it such that when you create that incremental impact, you are also creating those financial metrics that you're going to need in order to keep raising your BCD or not raise it in an ideal world and just grow on revenue because you're crushing it so much. So I think that that's one thing that's very important. And the other thing that I can think of is we're a public benefit corporation. And that was a weird decision to make when we did it. A lot of VCs said, don't do it. It's going to prevent you from raising money. But we did it anyway because a public benefit corporation is a legal designation in Delaware and some other states where you can actually have a fiduciary duty to your shareholders to not only maximize your profit, but also maximize your mission. And that allowed us legal protection in order to go after both of these things at the same time. That is something that would be helpful to decide at the very beginning. So I think as founders, making sure you are super aligned with your other founders on like how much of this, us starting this, is because we really want to do this impact thing versus how much of this is building a really big company, and making sure you are very clear on what you want to do and how you're going to get there, whether it's your legal structure, who you pick as investors, who you pick as employees, how you design your business model. Those are really important conversations to happen upfront.
I think that message often gets like pretty muddy, right? So I think, that clarity is really important. And I guess, Kabir and Amias, I'll look at you here, but, when you get kind of those two distinct narratives kind of bundled into one package, how do you make sure that you have the right kind of expertise to look at that and then really understand and determine that that's a business? And I'm specifically asking this question because Amias, you kind of commented that if the founder's kind of mission and their objective does not align with the investor's understanding of the world, then that relationship is not a match made in heaven. It just goes away. But often you kind of have that sense, right? Your spidey sense goes off and you're like, there's something here. I'm not really sure because it's outside of my world of understanding. How do you kind of make sense of all that, right? Because these are really revolutionary. People didn't think like this, in fintech's past, right? This is really very much a notion that's kind of come out in 5 years and a very important one.
Yeah, so I think the kinds of conviction that can lead an investor to fall in love with a company can actually be various. They don't need to be as deep as the understanding that the founder has. So I want to just highlight one thing that Jimmy said a moment ago, and Kabir about the Propel business model, which is about engagement and loyalty. And so, one of the things that I think a lot of investors have conviction on is that if you can get high engagement, you will get high loyalty. And if you get high engagement plus high loyalty, you can build a big business. So I think a lot of regular way investors could easily have a way to agree with the Propel vision and Jimmy's insight without necessarily having any pre-commitments or understandings of the particular population that Jimmy has organized his company around.
I might say something here that is maybe contradictory to the direction of our conversation right now, because I find that I often get educated by startup founders about a space. It happens more often than not. I mean, they are the experts. They are the ones at the front lines trying to figure this out. Why that conversation works is because we have some alignment at a higher level. We are aligned on values. We are aligned on principles. We are motivated in a particular way. We connect on that front. And then after that, they are the experts in the space. And they have to then bring that excitement and conviction to that conversation that then takes the whole deal forward. So that happens more often than not at an early stage. And I think that's the best part about this journey for both investors and I think startups.
Thank you for that. So with that, we're at time. I'd like to hand it back over to DC FinTech Week, and just a huge thank you to our panelists. This was really, really educational for me, and I'm sure that our audience gained a lot of perspective when they're starting their own journey.
Thank you all. Good to see you.
Thanks, guys.
And we are just delighted to have back with us today a great conversation with some of our nation's leading regulators, Yelena McWilliams, the chairman of the FDIC, and also Michael Hsu, the acting comptroller of the currency. Now, these two individuals are on the cutting edge of conversations on not just banking, but also innovation and also financial inclusion. And they have some very unique perspectives to share with us today. And I wanted to thank you both very much for joining us, especially as we turn to this series of questions and interrogations on financial inclusion and technology. Thank you to you both. Chair McWilliams, you've spoken very widely about MDIs and CDFIs and their critical role in their local communities. From your perch, how healthy are these institutions? There's been a spate of attention focused towards MDIs and CDFIs in terms of the economic assistance that they bring to their local communities. What are the big issues that have been addressed, particularly in the last couple of years, and really what's left on the table?
Chris, that's a great question. And thank you so much for having us at this phenomenal conference that you put together every year. It's always an honor to be here. So I will say that my focus on MDIs and CDFIs in particular stems from their purpose. They are very unique entities. They are mission driven. We call them mission driven banks. And the reason that we call them that is because they serve such a central purpose in their community. They're more than just a bank. Quite often they're kind of the thread that keeps the whole community together, that finances community. This is where you get your mortgage. This is what you get, your student loans if you need to, loan for your kid's car, et cetera, et cetera. So and they usually function in communities that have traditionally been either underserved or not served as well by mainstream banks. Quite often they're in low and moderate income communities, communities of color, rural communities, et cetera. So where credit is desperately needed, capital is desperately needed, but it's not as widely available as it may be in some of the bigger money center banks and neighborhoods. And so when we talk about them, we have to focus on what the mission is and then appropriately address what they need to fulfill that mission. And I will say that in the last couple of years, there has been ample of attention paid to MDIs and CDFIs, namely because of the kind of a cultural shift that we're going through as a country, with emphasis on underrepresented communities and communities of color, and then by consequence of that, what these banks are doing in these communities. So I will say that the health of FDIC insured MDIs and CDFIs is generally consistent with that of FDIC banks that are not MDIs and CDFIs. Their returns, MDI in particular, return on assets and return on equity as of June of this year is slightly higher than all banks and community banks. The core capital of the MDIs and CDFIs is slightly higher than all FDIC insured bank, and just slightly below FDIC community banks. But now what we are seeing is that they do have non-current assets and net charge-offs somewhat higher than all banks and community banks. So that's something that we look for to ascertain how do they compare to the kind of a just general bank and banking sector. And so when we look at that, we understand that they are going to be the first ones to experience the effects of economic downturns. So what may be a small undulation for other banks, it may be much bigger in their communities, right? And so we want to make sure that what they experience is they're able to absorb, because it's going to be whatever they experience with an economic shock, it's going to be exacerbated for their community and amplified. So when we look at that, we like to see that they have capital buffers, that they have some ample capital to withstand economic shocks. We look at the market that they serve and how likely are those markets and the consumers going to be able to stay in their homes, maintain their mortgages, pay their bills for the health of those banks as well as the communities. And so when we look at that, we realize that more help is needed for MDIs and CDFIs because the economies of scale simply don't work to their advantage. Because of the populations that they serve, they're quite often economically disadvantaged. And so when they maintain those deposit accounts, it costs them more on a per account basis, right? So one of the things we did at the FDIC is focus on all of that. We created a number of pathways for MDIs to prosper and give them more prominence in our regulatory and supervisory landscape at the FDIC. But also we did this thing a few months ago. Well, really for the past 2 years, we've been developing it, and we unveiled it last week, which is Mission Driven Bank Fund, which is a capital investment vehicle that is going to be funded by outside parties. Right now, we have Microsoft, Truist, and Discovery as main investors, and they have pledged about $120 million in this fund that we put the brand of the FDIC behind it. We set it up as an agency, but we can't fund it because of our government mandate. And we expect this fund to have 1 to 10 leverage in the community. So for every $1 in this fund, there's going to be about $10 worth of lending in the communities where MDIs and CDFIs serve. So we're very excited about that. And I look forward to discussing this a little bit more in depth with you.
Well, that was an amazingly useful kickoff to the conversation. And you know, Acting Comptroller, when you hear that response, it's one that really pinpoints both the mission and the importance of these institutions as anchors in their community. There was a highlighting of the many different kinds of roles, you know, that you have to do a lot more with a lot less, but at the same time, you know, the specific kinds of challenges that they face with regards to both their customer base, their assets, and their deposits, and really thinking through how they scale. What's your view? What's your take, again, from your vantage point on the health of minority banks, and what you view as some of the big technology issues facing them?
So I think one way to think about this is headwinds and tailwinds. So I think a lot of MDIs are facing quite a few headwinds, even going into the pandemic. The number of MDIs was shrinking. I think a lot of them had challenging outlooks. And then you have the pandemic, in which case we all know the pandemic has had a disproportionate impact on communities of color, on underserved, on vulnerable communities, of which that's one of the primary customer bases for the MDI. So there's kind of a double whammy effect there. So I think that's quite a few headwinds. And then also with the pandemic, mass adoption of digital, right? So now you pivot to the technology question, and those that are technologically prepared and able and ready to take advantage of that, fintechs and others, have really seen that growth. And I think institutions such as MDIs have some serious challenges there. Now, with all of that, I think there are now some tailwinds which are positive. So I think, as Chairman McWilliams highlighted, in the aftermath of the George Floyd protests, and I think a lot of just general reckoning around the country, around systemic racism, disparities, inequality, I have seen, I think we've all seen quite a bit of commitment to help. So there's a lot of commitment to help, and it's not just money. So the money is really important. And I'll just do a quick side note. We launched this Project Reach at the OCC, which was really all about addressing barriers to financial inclusion. And the setup is we use our convening power, just bring together banks, leaders of banks, technology firms, community groups, civil rights groups, all together at the table, say, what are the major problems and what are the solutions? And revitalizing MDIs was one of 4. So there are 4 of them, but it was number 1 was revitalizing MDIs. And what does that mean? They need capital, they need training, they need technology. There's a whole suite of things. In the last meeting we had, we were talking to MDIs. It's interesting. They said, now we've got this other problem. We've now got lots of capital. And so now they need to grow. And now what they're looking for help on, how do you grow quickly, responsibly, right? Because how do you double in size? And you want to be able to do that. And, Yelena and I, if we see banks doubling in size, radars go up. Like that's something you really want to watch carefully. But how do you do that to the advantage to support the mission that's so critical for those communities in a way, because they badly need it. And so I think those all kind of work together.
Hey, Mike, only your big banks grow in size, double up. Mine are very responsible and slow to grow.
Well, as I will, this is great. I get to play the academic referee between all of our nation's frontline responders. I think though it's a really interesting point. It's like, so, sometimes we think about scaling as, maybe something we want to be a little bit cautious about, right? Yeah. We may be worried about what what kinds of risks that may generate, known and unknown. But then sometimes, scaling can be really essential. It can be essential literally in order to achieve the purpose of financial stability. That there's a certain amount of scale that is required. And in a digital economy, those questions as to what constitutes or comprises an appropriate scale, I think are, I think a lot of people are trying to revisit. I'm a little bit curious about this question about sort of how you get there, and opening up this question about digital transformation, and the question about the entire ecosystem and what kinds of partnerships could be helpful for not necessarily just bridging the digital divide, but actually going digital for many of these institutions. And I'd really like to have both of your views on this. There was a sort of intergovernmental, really fascinating OCC FDIC conference, but maybe you can just recently where I got to sort of participate and get an inside look on it. But I think it'd be really helpful for people just to get a sense as to, the universe is vast in fintech. We have banks, we have fintechs, we have MDIs. What does an appropriate, for the FDIC, we'll start off with you, Chairman McMillan, what does an appropriate partnership look like for these institutions?
So I will say that for a lot of these institutions, because of the scope and the size that they have, and this economies of scale that we mentioned and you briefly touched upon, it is almost essential that they're able to enter into these partnerships. Now, why? Because the partnerships are something that allows these MDIs and CDFIs in particular to have a broader platform without actually making the kind of the onboarding investment, the building up investment, the kind of a starting from scratch investment, which is in a lot of cases prohibitively expensive for very small banks, including community banks, not just the MDIs. So when we think about these partnerships, I see that as an opportunity to expand their base, frankly, to offer more products and services in a more efficient manner. And the trick for us on the regulatory side is how do we manage those partnerships, right? Because again, you want them to scale up responsibly. You want them to expand their customer base responsibly. And when you talk about third-party partnerships, not all third parties function in the same ecosystem as the banks. And as you know, banks are heavily regulated. So what we like to see is an opportunity to create these third-party partnerships in a way that actually we on the regulatory side, being as risk-averse as we are, we can live with. So we have created a number of pathways for that to be done at the FDIC and with our sister agencies with OCC and the Fed as well. We issued guidance documents on how to think about third-party partnerships. We have engaged in a number of initiatives through our Office of Innovation, FDI Tech here, including we had a tech sprint on kind of how to expand economic inclusion through MDIs, community banks, et cetera. And as well as kind of a thought about fundamentally, how can we change the relationship of third-party service providers and small banks, including MDIs and CDFIs. And one of the things that we did was start thinking about this project that we're developing about the standard setting organization that would basically, it would be a public-private partnership, and it would do the due diligence process for onboarding third parties. Basically, it would examine the third parties and then issue them a good housekeeping seal of approval that then they could present to the bank and say, hey, we have been FDIC certified, so to speak, or this organization certified, we're clean to be onboarded. And that way we can save the time for that small bank that maybe have a staff of 10 from spending 100 to 200 hours onboarding this third-party technology provider and being able to engage in a partnership. So that's something we're looking at. We're also trying to figure out how can we provide a better venue through technology of exchanging data with banks. As you know, FDIC collects call report data. We collect about 2,400 fields of data from larger banks and slightly over 1,000 from smaller banks every 3 months. And that process stems from the actual National Bank Act from the 1860s. And it used to be paper production, and they would mail the paper production. Now it's e-production where they send us this information. But nonetheless, from the moment when they start collecting information at the beginning of the quarter until we get it, it's about a 4-month process, right? And so can we create a better way that actually is going to take less resources on the part of the community bank and larger banks to transmit that data more instantaneously and give us a better ability to see kind of a more rapid movement inside that bank so that we can also monitor for financial stability and see if any of these partnerships should give us concern or not. So we're thinking kind of how can technology be used to help, especially small banks, reach a broader audience, reach this broader customer base, offer more products and services without actually having to do the ground zero investment in technology and innovation that they simply cannot afford.
That's extremely helpful. And even later on today, we're going to have these presentations from many of our literally they're from all across the ecosystem, trying to think in some instances about partnerships with MDIs and what they could look like, especially given challenges like onboarding of new technology and the like. Acting Comptroller, maybe I would love to get your perspective here as well. And again, just as a brief aside, very often this question of data and information is super important. I find it fascinating that a lot of these banks have information because of their customer base that the larger banks don't have. So maybe there's a way to not only equip them but also highlight their own competitive advantages, given their experience. But how do you look at that partnership question, and where does the OCC fit in?
So maybe I'm going to contrast a little bit where Yelena was talking about some of the fintechs, those partnerships. I think for I think all the MDIs, CDFIs, a lot of community banks, the key partnerships right now are with the cores. So there's core service providers, Fiserv's, Jack Henry's of the world, provide a lot of middle back office functions. And a lot of the cores offerings are geared to larger institutions. And so what ends up happening is because the MDIs tend to be smaller, that they kind of get lost in the shuffle of these things. And I think this is actually highlighted in one of the papers, because NBA, the National Bankers Association, we work with them too. They're one of the founding members of Project Reach. And this has been highlighted that they have real challenges dealing with tech companies that are used to dealing with really big numbers, really big entities. And so to get like the tailored pricing and the tailored services can be tough. And it could just not be a priority. The economies of scale don't work unless there's a commitment to do that. And so we have worked with NBA through Project Reach to sit down with the course and say, hey, here's what these guys need. These guys need X, Y, and Z. Can you tailor it? And I think that at least in one of the article, I think it's with NBA and Upstart, said, hey, some of the technology firms can do that as well. And I think that there is this is something we're gonna have to grapple with. Part of the promise, what makes tech so, have such high valuations that they can scale. And so it's a numbers game. How many people can we get? How many eyeballs, how many clicks? Whereas the MDI game is different. It really is, it's a relationship game. And so how do we blend these things together so it achieves the mission? And I think that's really the crux of it. And so the OCC, we try to make sure that those interests kind of get aligned and get observed, and we try to take action on those fronts.
So that was a great and really eloquent observation that at the end complicated things, right? Because I was like, okay, I'm here, and now, we are dealing with institutions with different kinds of missions. So how do we apply, again, getting back to our earlier conversation, some of our own sort of economic expectations about what is good and what is appropriate? Just sort of sticking through, with that technology conversation, and you had sort of mentioned one of the papers with the NBA and the National Bankers Association and Upstart. But it's fascinating because the explosion of innovation, I mean, you can't escape it. I mean, whenever you read the papers, whenever you're looking at the news, the financial press, that there's this hugely broad swath of new technology, and part of the job of a regulator is to remain technology neutral, but also to sort of kick the tires with the technology to see if it works and in a way that's not going to imperil the financial system, and see if it can actually achieve some of the mandates and interests of the agency. When you think about that, Chairman McWilliams, and all that new technology, are there any areas that from the FDIC standpoint, you're seeing technology being deployed particularly successfully in the context of MDIs and CDFIs? Are there any technological solutions that appear to be more promising given the needs of MDIs and CDFIs and where they're finding themselves in this sort of digital economy?
Yeah, as Acting Comptroller Sue mentioned, they're primarily dealing with these core processors that have been in the game for decades. But now we're seeing, frankly, being technology neutral without mentioning the names, we're seeing some challengers come into this space, and they are able to, they're hungry for new customers, speaking of them scaling up, but they're also kind of able to provide at a good price point, kind of a bespoke approach to what MDIs may need. And Mike mentioned that MDIs in particular are relationship builders. This is where your grandfather, borrowed money to open up a barber shop, and now you're going to borrow money to purchase your first car, right? And there's that generational banking. It's kind of like the banker is a part of your family in a way. Kind of I like to call it the Norman Rockwell. MDIs are the Norman Rockwell picture of the relationships and America. So it's frankly something that we're focused on through our FDI Tech, our Office of Innovation, to explore ways we can actually support digital transformation in this mission-driven banks. I mentioned we did an inclusion tech sprint, which explored new technologies and techniques that would help expand the capabilities of community banks and MDIs, especially with respect to the needs of unbanked and underbanked households. But also there is quite a bit of work we have done on creating partnerships between MDIs and non-MDIs. I call them speed dating. We literally put, we held these roundtables around the country. I said, this is not your grandmother's FDI. We're going to be speed dating. And so we set MDIs and non-MDIs at these tables, round tables of all things. And so you have 6 minutes, go talk to each other, see if there is an opportunity for a partnership. And that partnership, quite often when you think of a traditional partnership is like, okay, so I'm the non-MDI. I would like to help MDIs in my footprint because we all can benefit and prosper from that. The communities will be better off. So I put deposits in that bank. Well, deposits are not going, it's good, but they're not going to solve their issue. They need capital, they need technology, they need investments. So now we have through Microsoft and this partnership we have with Truist and now Discovery on the mission-driven bank fund, there's the technology component there that's going to be, I think, extremely, extremely important for the MDIs. And just, I think as regulators, just keeping an open mind on how can we do more with technology? How can we responsibly employ that technology to actually help MDIs, scale up in a way that we want them scaled up, but it's going to retain that, Norman Rockwell-esque charm that they bring to the third, fourth, fifth generation of banking in small communities.
Norman Rockwell charm and speed dating all in one answer from a banking regulator. I love it. But there's some truth to it. Even as I said, for this next component, and it was great. We have Congressman Meeks and others who sort of chipped in. But I think that there's a sense that as technology grows, and even as the new technology companies themselves feel this need to scale, the question is, in that life cycle, in that period, even before they've reached that point of reaching the scale that they may be looking for, and I love the idea of a numbers game, literally, it's a question of, to what degree are they thinking about other allied strategies as well as underserved persons, and how can you make that work? Acting Comptroller Sue, I know you've thought about technology a lot recently. Are there any pockets or areas that you're seeing working or potentially working for this particular subset of banks?
So I try to toggle between thinking about technologies as technologies and thinking about problems for which technologies can solve. And I think on the latter, especially in this space, it's really, really helpful, and I would say necessary, to anchor ourselves and say, what problem are we solving? Otherwise, it's really easy to get all caught up in the latest gizmo and to just push the gizmo for the sake of pushing the gizmo, and that may not help. And so, for instance, like in the financial inclusion space, credit invisibles is a big problem, right? We know there are a lot of people, especially people of color, who don't have a traditional credit score. And if you don't have a traditional credit score, you can't get a mortgage, you can't buy a car, you can't start a business, like you really hampered, you are excluded from the financial mainstream to do the things that build wealth, build your financial capacity. And one of the other work streams in Project Reach, besides MDI revitalization, is on invisibles. And one way to solve invisibles is that use other data. There's alternative data, and banks have tons of data. They've got your payments data. And so they can say, oh, this person, you pay your rent on time, you're paying your utilities, you're credit worthy, even though FICO doesn't think of you as credit worthy, let's give you a loan. And I think that has a lot of promise. Now, as you know, these kinds of data things require like huge amounts of data. Yeah. And I think for a single MDI, there is it's almost a scale problem in terms of data inputs. I thought it was interesting. There was another piece in the package that talked about essentially pooling resources across MDIs to say, hey, if you pool, maybe we can kind of achieve those thresholds, those data thresholds together. Very interesting. And I think that that's a really ripe space because it's got a directed problem. And I think if you can solve that problem, really clear, concrete benefits start to accrue. And you can see that in other places. I think the real question is, especially for communities of color, how do you build wealth? This is to me, how do you make it less expensive to be poor, and how do you build wealth? Those are really critical things. How does technology help with those two things? That's a really interesting and rich discussion.
Well, this has been an interesting and rich discussion. I can't say enough to you both how much I really appreciate you both coming by and to share your views. And we look to having you on in the future for our future FinTech Weeks 2080 and the like. But thank you so much for your time.
Mike, be careful. That's how he suckered me into showing up every single year for the next
year. I'm looking forward to next year already.
This is true. This is true.
Thank you, Chris.
Thank you so much, Chris. And thank you, Mike, as well. Bye-bye.
Now we have a treat. We asked some of the leading financial technology firms in the world, along with startups just beginning their journey, to offer, as you have just heard, some suggestions on what the sector might be able to do to help CDFIs and MDIs. We just wanted to brainstorm with some of the best and brightest to get a sense of the possible and the practical. Now, we've written up and published an overview of these suggestions in a report entitled Future-Proofing Inclusion, Technology Proposals for CDFIs, MDFIs, and Community Banks, which is on the dcfintechweek.org website. And in addition, I asked them to draft and to prepare flash presentations to get their ideas out visually and quickly, and we'll mull them over with leaders from minority banks and financial institutions afterwards to get an assessment of their particular technology solutions and what proposals seem particularly relevant to them. I hope you enjoy.
Hello, my name is Alex Levatov, and I'm a Senior Director at K2 Integrity, a strategic advisory firm dedicated to financial integrity and security. Today, I'll be presenting a paper co-authored with my colleague Gail Fuller, a Managing Director at K2 Integrity, about an innovative tool we've developed with our partners, the tech firm Giant Oak, to promote financial inclusion with federated learning. The solution we built is an approach based on federated learning principles that operates through our joint venture called Consilient. I'll walk through its structure and applications in just a moment. But first, I want to take a minute to explain the challenge it's designed to address. When it comes to pricing and extending credit and managing a host of other risks, a bank's decisions are only as good as the information and analysis on which it relies. Where such information is lacking, or worse, where it's misleading or biased, banks may shy away from doing business with customers or markets perceived to be high risk, leaving already underserved populations without access to vital financial services and missing out on business opportunities. Relying on incomplete and often inaccurate tools for measuring creditworthiness, banks in the US have long tended to avoid rather than manage the risks of providing services to the 53 million Americans who lack a traditional credit score, or the 56 million more whose credit scores are subprime. Those without a traditional credit score struggle to obtain mortgages, credit cards, or bank loans, and often must resort to high-cost loans that may not help build a credit history, even when successfully repaid. Even where consumers do have a traditional credit history, more than 1 in 5 has a potentially material error in their credit file. The problems of inadequate credit scoring disproportionately impact Black and Hispanic borrowers who have not had equal access to home ownership and other sources of generational wealth, and those who live in low-income neighborhoods. Even mission-driven banks like CDFIs and MDIs, which serve low-income and minority communities at higher rates than mainstream banks, may find it difficult to accurately risk rate a largely credit-invisible customer base and price credit products accordingly. Initially pioneered to help banks discover and manage their illicit finance risks, the Consilient model can help small and mid-sized banks in the US, especially CDFIs and MDIs, to better understand, assess, and manage the risks of serving customers who lack traditional credit scores or whose scores may inaccurately reflect their true credit risk. At the core of Consilient's technology is the principle of federated machine learning, which allows different institutions to gain insights from one another's data, not by moving the data into a centralized repository, but by moving an analytic algorithm to the various local data environments. As the Consilient algorithm travels across a consortium of participating banks, it ingests, trains on, and learns from each institution's data, adjusting the model's weights and parameters as it's fitted to the local data, and sending encrypted updates to a secure aggregation engine without removing any data from its local source. By bringing the algorithm to the data rather than the other way around, federated learning allows banks to share insights and perform machine learning without revealing raw data to competitors or transferring sensitive customer information to the cloud or a single centralized data center. 3 features of the federated learning model make it especially well suited to help CDFIs and MDIs safely and cost-effectively expand access to financial services. First, it brings together the right partners. With small data sets of their own, and lacking insight into other institutions' experience, CDFIs and MDIs have often had to rely on third-party credit scores that may be unreliable and even biased against the very populations they are designed to serve. The federated learning alternative would allow CDFIs and MDIs from across the country to partner into a consortium of like-minded, mission-driven institutions, expanding the pool of relevant data available for analysis and leveraging their unique understanding of low-income and minority communities and their financial services needs. Second, Consilient targets the right training data. Traditional credit scoring models rely on consumers' history of repaying debts, such as mortgages and bank loans. Yet these data sources paint at best an incomplete picture of a consumer's creditworthiness and neglect a range of other well-documented measurable indicators of credit risk. The Consilient algorithm would fill these critical data gaps by training on so-called alternative data, including a consumer's history of paying monthly rent, utilities, and cell phone bills, which can show a fuller track record of financial responsibility. Drawing on this expanded range of data sources across a consortium of banks, the machine learning algorithm can then identify risk attributes that have not been weighted accurately in past credit decisions and apply the corrected model to the assessment of prospective customers and lending opportunities. Just as importantly, the Consilient model updates continuously to account for new data, allowing banks to more accurately track consumers' changing behavior and financial circumstances. Third, Consilient rests on a cost-sharing model. Creating a new risk scoring model from scratch requires time, data, technical expertise, and other resources that may not be available to most small or mid-sized financial institutions, especially those disproportionately serving low and middle-income customers. However, the federated learning model is also a cost-sharing model, allowing participating institutions not only to learn from one another's data, but to pool expertise and resources in a way that dramatically reduces the cost of piloting such a solution alone. Let me close by explaining a final indispensable feature of the Consilient approach: ongoing and expert human oversight and governance. Alongside its many benefits, we recognize that machine learning technology left to operate on its own also has the potential to exacerbate existing bias and further entrench historical patterns of discrimination. For example, traditional metrics for assessing risk, such as location of residence, closely track racial and socioeconomic categories due to historical patterns or policies of discrimination, like segregation and redlining. In the absence of expert monitoring and intervention, machine learning algorithms may naturally assign risk relevance to factors that, while apparently neutral, are in fact proxies for race or other suspect variables. Following the approach Consilient has instituted for other federated learning consortia, any application of the Consilient model would be subject to rigorous governance and oversight mechanisms, including model tuning and routine intervention by subject matter experts to uncover proxy discrimination and other biases imposed or perpetuated by the technology. The Consilient approach to governance would complement traditional fair lending testing already underway and ensure that the new model can be explained and justified to supervisors. Based on more and better data, informed by practitioner expertise, and driven by machine learning technology, Consilient would bring CDFIs and MDIs into an active partnership to improve their understanding of risks and expand financial access to creditworthy, profitable, yet traditionally underserved customer populations, advancing financial inclusion, equity, and security. Thank you so much for listening.
Hello, and thank you for the opportunity to present our paper and thoughts on how technology can solve for the inclusion imperative for our housing industry. We are excited to be part of this year's DC FinTech Forum and share our perspectives with you and learn from others. I'm Brian View, President and COO at FinLocker. We are a St. Louis-based, fast-growing FinTech startup, and we focus on financial fitness to create educated and empowered borrowers who are financially ready to pursue their dreams of housing and subsequent wealth building. As most of you in the audience here at the DC FinTech Forum know, access to credit and housing is increasingly detached from those who need the most assistance, which is new entrants and re-entrants. Approximately 63 million adults in the US are unbanked or underbanked with no on-ramps into the financial system. The percentage of Americans owning a home was 64.8% in Q3 of 2020. When homeownership rates are viewed by race, the disparity is apparent. 75.8% for non-Hispanic white alone householders and 46.4% for Black alone householders. The COVID-19 crisis hit low to moderate income families extremely hard. Historically low housing supply coming out of the 2009 financial crisis, combined with a low interest rate environment, drove up housing prices, putting homeownership out of reach for millions of consumers. The rental market did not fare that much better, and for many renters, housing is north of 50% of their total monthly income. In short, our country's financial inclusivity efforts continue to fall short, and CDFI, MDI partnerships with fintech companies can help close the inclusivity gap. We see a myriad of opportunities for technology to help solve for the above-mentioned problems and affect better inclusion in the housing industry. Concepts like artificial intelligence and machine learning, advanced data and analytics, cloud computing, blockchain, and many emerging technologies have great potential to affect financial services industry in a positive way when applied correctly. While we are bullish on the power of technology to solve all the above-mentioned problem spaces, we will focus on a subset of the opportunity areas in this paper. And the focus in our paper will highlight getting consumers mortgage ready or accelerating their approvability, helping consumers avoid gotchas with contextual, contemporary, and timely education and tools, and supporting decline to approval by moving our industry from optimizing transactions to serving longer-term relationships. We chose these themes in our paper because we believe that housing is the anchor for financial well-being, and that lenders can better serve borrowers and consumers alike by meeting them where they are in their financial journey. We believe this hyper-personalized financial nurture and mentorship-based approach will create more opportunities and a more inclusive housing finance infrastructure, especially as we look at the demographics and diversity in the borrower pool of tomorrow. So let's talk about our theme number one, which is getting consumers ready. I think a valuable investment our financial institutions and fintechs can make is in assisting borrowers to get ready well before they enter the mortgage origination process. What if borrowers were empowered to carry their readiness to a mortgage outlet when they were ready to buy, instead of first finding a home and then looking for a mortgage approval? We at FinLocker see readiness as more than an underwriting approval stage of the loan process. Readiness is a deeper concept of ensuring a full understanding of the mortgage process and more importantly, the financial implications of securing the right product at the right price. Theme number 2 in our paper discusses avoiding gotchas. You don't know what you don't know, the impact of financial literacy. Studies from TransUnion and NerdWallet predict anywhere between 20 to 26 million first-time homebuyers will be entering the US housing market in the next 5 years. This is by far the most diverse home buying population our industry has ever seen. According to a Fannie Mae study, only a fraction of consumers know the required scores or down payment amount that's required to qualify them for a mortgage. We list out those home buying myths in our study, and then we set to debunk it in our paper. When you combine low levels of financial literacy along with affordability challenges, alternative banking or credit product usage, and the rising student debt trends in the consumer population, consumers are incorrectly self-selecting out of credit markets, especially the mortgage market. As our counseling industry has proven, especially in underserved communities, there is a place for contextual and timely advice that drives outcomes for consumers. However, not all financial literacy is created equal. What would be most beneficial for the consumer of tomorrow is personalized advice that is relevant to their specific financial circumstances, provided by a trusted source. CDFIs, MDIs, partnering with fintechs looking to solve this particular need can deliver the intended lift at scale and at a low cost per consumer. Let's look at our third theme in our paper. What do we do about an industry that's been hyper optimized for gain on sale? Existing players in the mortgage market remain hyper optimized for transactions and volumes. Our financial markets have rewarded this business model, as evidenced by a number of independent mortgage banks generating sizable valuations in the equity markets over the last 2 to 4 years. While the current state of the mortgage industry is profitable, results in homeownership rates show that the model is not serving all segments of our society equitably. There is a significant opportunity here for CDFIs and MDIs to offer a better product, one that optimizes for the financial well-being of the consumer as the primary outcome and gain on sale as a secondary outcome, with the notion that a financially healthy customer for life will generate more value for a financial institution over time. No one solution or technology can solely address the underserved markets. FinLocker believes a combination of technology developments together with deep partnerships across the industry, especially those in the CDFI, MDI community, will be essential, as Robert F. Smith calls them. CDFIs are the capillary banking system. This segment of our financial services community working with fintechs to develop a set of tools and methods to address deep-rooted financial inclusivity problems of access and true lifetime financial mentorship will have the most impact. In summary, housing forms the anchor for wealth building for a majority of the middle class in the US. Access to safe and sustainable housing finance is imperative for the consumer's financial well-being. Education packaged and delivered in contemporary settings is an important investment that our industry should make to bring more consumers into the market. CDFIs and MDIs can play an important role in this area of advocacy and literacy as a trusted brand, partner, and advisor to the community to help them understand their options and achieve readiness in a safe space and watching out for their longer-term financial well-being. We thank the DC FinTech Forum organizers, especially Dr. Chris Broomer, for the opportunity to be part of this forum. We hope you download and read our paper and engage with us and drive the conversation forward. Thank you.
Hi, my name is Todd Fox. I'm the head of global policy at Visa. It's an honor to participate in DC FinTech Week and to partner with the Georgetown University Institute of International Economic Law on this important piece of work about future-proofing CDFIs and MDIs. Visa created an Institute for Economic Empowerment as part of our overall commitment to uplifting economies and helping make the digital economy a flywheel for economic progress everywhere. And that's certainly the case in the United States, where a new generation of fintech founders are working with Black and brown banks, MDIs, and CDFIs, as well as existing networks like Visa, to put the digital economy in reach for as many people as possible. And this is an urgent issue. The pandemic showed us that there's a huge cost of being excluded from digital economic infrastructure. A study by McKinsey found that closing the racial wealth gap in the United States could unlock between $1 and $1.5 trillion in economic activity over the next 10 years. So we wrote a paper, and it was an honor to have it included in this ebook. And what we shared in the paper, I would encourage everyone to read, but I'll just give you a couple of the key points. As I mentioned, there are challenges for participation in the digital economy, but partnerships can help overcome those challenges. One challenge is scale. The ability to connect to billions of individual account credentials, an acceptance network of over 70 million merchants, and to be part of one of the most trusted payment networks in the world is certainly one way of enabling Black and brown banks and fintechs to participate in the global financial ecosystem. But there are many more ways to do this, and it's important to note, Visa is not trying to be prescriptive of exactly how financial institutions should participate. The real heroes of DC FinTech Week and of the fintech ecosystem overall are the founders, the entrepreneurs, the innovators that find new and creative ways to combine the capabilities that already exist and then to push the envelope into new areas so that we're creating new types of delivery devices for financial services. And that's happening all over the world. One of the important roles of a global payment network like Visa is to make sure that wherever those innovations arise, they're reaching as many people as quickly as possible at scale. Our paper identifies 3 areas where businesses like ours can help Black and brown financial institutions achieve their goals. 1, innovation sandboxes. We provide a secure space for innovators to innovate, which is really what they do best. There's the Visa FinTech Fast Track program, which allows fintech companies to get more quickly connected to our network. There's the Visa Developer Platform, which is a way of accessing our products and capabilities through APIs. And there are countless initiatives underway all around the world to just find new opportunities for value-added partnership. We're also trying to make our existing products better to meet the needs of underserved communities. There are existing technologies and new products coming online that when Visa joins forces with the relevant partners can actually unlock new capabilities. The paper talks about work we're doing with the neobank in the United States to solve the problem of credit invisibility, which is quite exciting and a potential model for other countries to follow. Lastly, there's an education and financial literacy opportunity to enhance the financial capabilities of all people. So if you are interested in these topics and committed as we are to building a digital economy that includes everyone everywhere and partnering with governments to make the digital economy attainable to everyone, please join us. The Visa Economic Empowerment Institute and our partners are eager to have as many ideas as possible that we can take and help explore new venues for partnership and collaboration to close the digital gaps that exist and make the economy more equitable and accessible to everyone. Thank you.
Hello, my name is David Rickster, CEO and co-founder of MStreetX. MStreetX is a fintech platform designed to support CDFIs and MDEIs. In today's discussion, we will discuss our white paper, Connecting Deserving Communities to Resources in the Digital Economy. Rethinking CDFIs and MDEIs and technical assistance. In many underserved communities, CDFIs and MDIs are connectors to an ecosystem. that allows many of its customers access to capital through their services, which includes wraparound technical assistance and guidance on graduating the unbankable to bankable clients for financial institutions. These mission-driven banks play a vital role in the financing continuum. Leveraging the State Small Business Credit Initiative. At the height of the pandemic, over 20 million jobs were lost in the US economy. The job losses had a disproportionate impact on rural and minority communities, where CDFIs and MDIs typically serve. This begs the question, what if mission-driven banks could leverage emerging technologies to build operational capacity, accelerate and deploy capital to LMI communities? How many businesses and jobs could be saved or even created? One viable solution as a minimum tool is the State Small Business Credit Initiative. Reauthorized through the American Rescue Plan, this private-public initiative provides eligible jurisdictions, states, DC, and territories, and tribal communities $10 billion of funding to support economic disaster from the pandemic, including equitable opportunities to underserved communities by providing access to capital to small businesses. During its initial programming through 2010 and 2017, SSBCI identified best practices, one which was partnering with CDFIs. As mission-driven banks, CDFIs and MBIs participate in SSBCI in helping states meet their leverage projections, access additional loan capital. CDFIs can act as lenders, receive credit support, and act as contractors administering state programs, and even can participate as borrowers themselves. We believe that CDFIs would have a greater share with SSBCI. The Biden administration is intentionally leveraging SSBCI to provide $1.5 billion in funding to socioeconomic disadvantaged community businesses. It is our view that CDFIs and MDIs should have an increased participation with SSBCI and other federal and state and local initiatives, and to do so with a laser eye focused on digital transformation and strategy. The importance of AI and machine learning. For CDFIs and MDIs, AI and machine learning has the potential to increase internal operational efficiency, reduce processing and interaction times for the customers that they serve, and optimizing core functions to accelerate progress towards achieving their missions. As an example, MStreetX's capital access application tool, known as the CAT, streamlines the process for a CDFI and an MDI to receive, secure, process, and store applications for capital access programs. The CAT leverages a secure API to intake application documents and uses AI technologies to extract content from the document to perform compliance checks required by the CDFI and MDI. The tool securely stores the information in a cloud-native database and presents to the authorized CDFI and MDI staff for further examination. CAT's AI also provides CDFIs and MDIs with the ability to detect anomalies in its portfolio. With CAT, a CDFI and an MDI has the ability to perform real-time ad hoc queries and generate reports on that. Imagine being able to identify a transaction throughout its life cycle. That's what the CAT will perform. On the other side, on the client side, for example, a New Mexico business can use the Business Finance Finder, a component of MStreetX technology stack, to see if a CDFI and MDI matches their needs. And we can forward to the next slide. Here we see the Business Finance Finder has the ability to match a business with a CDFI and an MDMI based on their needs. It is our recommendation that fintech platforms such as MStreetX should be leveraged to support the FDIC in its newly established mission-driven bank fund to augment a CDFI's and MDI's ability to provide new services. The ability to leverage data in a way to understand the patient capital that's needed to support the most deserving communities is what the platform is able to do. The opportunity to democratize access to resources is a collective part that requires participation of both public and private sectors to ensure the most deserving communities are aware of the resources available to them so that they can fully participate in our economy. Thank you.
Hello, my name is Ola Williams, and I'm the head of federal policy at Square. Today, I'm speaking to you all about our racial equity and social impact strategy through MDIs and CDFIs. But before that, we at Square would like to thank Professor Chris Brummer and Georgetown University Law Center for hosting the 2021 DC FinTech Week and welcoming our participation. I also want to thank the individuals who worked tirelessly to contribute to the work I'm going to speak on shortly. Before delving into our flash presentation, let me briefly outline my discussion. I will introduce the impetus for our strategy and then touch on the following points: our approach to social impact, defining a series of goals, solidifying investment parameters, cross-functional company coordination, leveraging our relationship to source opportunities, ensuring accountability by tracking impact, and a little bit of looking ahead. As some background, we have been mulling over what our role would be in helping solve the undeniable problem of persistent inequality and what meaningful actions we could take to address it. As a company dedicated to the economic empowerment of those left out of the mainstream economy, an essential aspect of our response was to leverage economics resources for community development financial institutions and minority depository institutions. These institutions are the ones that provide economic livelihood to many underserved communities through funding and services to people who otherwise would not receive them. So in the spirit of economic justice, we share our journey to implement a racial equity investment program. Let me first talk really briefly about our approach to social impact. Though we had begun working with CDFIs and MDIs in 2019, the mounting and successive racial injustices of last summer reinforced the necessity for our social impact strategy. As most of us are aware, through capitalization, CDFIs and MDIs would have more resources to lend forward to underserved communities, and in the process, assist more families seeking to buy their first homes and launch their first small businesses. Additionally, once we saw data on how minority communities have been disproportionately affected by the COVID-19 pandemic, there was a clear need to take a more immediate action. The centerpiece of our efforts was a $100 million commitment to invest in minority and underserved communities to further the goal of economic empowerment. The following is how we thought about defining our goals. We encourage firms to collaborate with employees, community groups, and stakeholders when creating goals for a social impact investment strategy. This allows the company and its investment recipients to partner on a concrete action. In our case, we distilled a series of goals focusing on our strengths and experience as a payments company. So we thought through a few of the following: allow CDFIs and MDIs to increase their capacity to make loans to local small business owners, an extension of our 2019 strategy. Help minority-owned small businesses grow through finance, and enable economic empowerment by providing unbanked individuals with access to savings and other financial tools that have been limited to those with privilege. Once we establish goals, we solidified the investment parameters. And so I'll talk next about how we establish those investment parameters. After reviewing our balance sheet and liquidity positions, we determined $100 million as the appropriate commitment in the current environment to drive impact. We also saw it as a reasonable amount as a percentage of our liquidity. We wanted to balance opportunities that aligned with our stated goals and with reasonable assurances of capital preservation through risk management capabilities. We also target a maturity date of 10 years or fewer for all investments. This was because 10 years is enough to be ambitious and also to demonstrate seriousness of attention and focus. Of course, a feat like this wouldn't be possible without cross-functional company coordination. As each investment opportunity presented itself with different risks and impacts that could only be properly and thoroughly assessed by a cross-functional team, we had to source input from teams across Square at the same time. This included our treasury, which reviewed our balance sheet to determine responsible asset allocation, policy and community affairs, which formulated the plan execution and communicated our strategy as policy to the outside world, legal, which reviewed all documentation to advise on structure, terms, and ensure compliance with policies, procedures, and regulations, tax, which evaluated target investments for tax implications unique to Square, accounting, which analyzed target investments for accounting considerations that could affect financial reporting, communications, which ensured clear communication of program goals with both internal and external stakeholders, and inclusion and diversity in ESG, which confirmed and attested that the program goals aligned with other internal and external efforts around diversity and inclusion and environmental, social, and governance initiatives. With these parameters, we were able to begin sourcing our opportunities. In order to do this, we leveraged the strong relationships built by our policy and community affairs team over the years with community partners at CDFIs and MDIs. This led us to the MDI Keepers Fund, an investment sponsored by the National Bankers Association, and also led us to the Black Economic Development Fund, pioneered by the Local Initiative Support Corporation and Netflix. We talk more about this in our paper, but while performing diligence on each opportunity, we weighed the potential impact of the fund against various risk factors, including the financial strength and track record of the fund, underlying loan quality, the composition and collective experience of the management team, sources of investment capital, and regional focus. We are tracking impact as a way to ensure accountability for us and our partners. Our partners are held accountable to their impact goals through annual reporting on metrics, including jobs created or protected, affordable housing units created or protected, number of small business loans provided, and many other things. We hold ourselves accountable at Square by transparently communicating these results to our company on an annual basis and keeping our board and Square communities, in other words, our employee resource groups, updated on our work on a regular basis. In concluding, though we have taken this path, it does not mean that we are not open to revising our approach and strategy in order to bring the best social impact we can to the people that need it most. Again, thank you to Georgetown University Law Center for putting this on. Thank you for listening to our 2021 DC FinTech Week Flash presentation. We hope that this illuminates the process for other organizations looking to make similar investments. Thank you for taking the time.
Hi, I'm Teddy Flo, Zest AI's General Counsel and Head of Corporate Affairs. MDIs and CDFIs face fundamental challenges that Zest AI helps them solve. Most critically, how do they help consumers by giving them access to affordable credit without compromising safety and soundness? That can be hard in low-income communities where many people have had bad credit or no credit, in part due to the systematic racism that they have faced for many years. At Zest AI, we found that artificial intelligence and machine learning present a once-in-a-generation opportunity to reverse years of systemic racism and empower CDFIs and MDIs to include more women and people of color in the financial ecosystem. We'll talk today about two technologies. The first is Zest's patented Fair Lending tool. At Zest AI, we got tired of seeing fair lending analysis that offered no solutions, that offered no way to make things better. And so we invented a technology that does just that. It allows lenders to increase the fairness of their decision-making without taking on additional financial risk. And the second piece of technology is Zest's open source tool that lets lenders amplify their fair lending analysis and improve outcomes for everyone. And what we're most proud of at Zest AI is that our tools maintain the autonomy and agency of MDIs and CDFIs by helping them do what they already do better, not by changing the way they serve their consumers. So with that, let's jump into the tech. The first piece of technology that we'll talk about, as I said, is Zest AI's patented fair lending tool. What you're looking at here on the screen is a chart that looks at various models that we've graded and categorized according to two metrics. On the x-axis, you'll see accuracy. That is, how accurate is the model at assessing the risk that a borrower is going to default on their loan. And on the y-axis, we are grading the models on fairness, which we measure here in this chart by the adverse impact ratio, which is a comparison of how protected groups are approved for loans vis-a-vis their counterparts. So comparing women to men, African Americans to white folks, and so forth. And so every dot you see on that screen is a model. What you see on the far left is the original underwriting model that a bank might have been using to make decisions. It has a certain level of fairness, it has a certain level of accuracy. The old ways of doing fair lending analysis would require banks to search for alternative models or less discriminatory alternatives, or LDAs. And that's those other dots, the three dots you see on the far left of the screen. And what you see is that with older methods, banks had to give up quite a bit of accuracy, and the models were still pretty unfair to women and people of color. With Zest's patented technology, we enable lenders to search millions of combinations of all of the features in the model and arrive at a whole series of different alternatives that are each more accurate and most of them more fair than what the lender was using originally. And so when a lender chooses to use one of these LDAs, or less discriminatory alternatives, they are able to increase approval rates for women and people of color while actually getting more accurate at assessing risk, which generally preserves their safety and soundness and often increases profitability for the financial institution. It's a win-win-win situation. But you might be asking yourself, what does this mean for real people? Are we just approving more people and they're going to default, which puts them in a worse situation? Well, on the next slide, you'll see that that's simply not the case. When a lender chooses one of these less discriminatory alternatives, because these machine learning models are more accurate than what they were using before, what actually happens is that default rates go down for people of color and women. What you see here is a default rate decrease of 34% for African Americans by using this less discriminatory alternative model. The default rate also decreased for women and also was maintained for all other groups. Again, this advanced fair lending tool is a win-win-win for consumers, for the bank, and for society. The second piece of technology that I'd like to talk to you about today is Zest's open source project, which we call the Zest Race Predictor. For those of you deeply involved in fair lending analysis, you are well aware that financial institutions are not allowed to collect race data on the applicants for loan products outside of mortgage. What this means is that to conduct fair lending analysis, the financial institutions actually have to estimate or guess at the race of the borrowers that are applying for loans. They have to do that so that they know what impact their lending decisions are having on different protected groups. The problem is that there's a standard in the industry called BizG. BizG was invented in 2008. It was fairly accurate. It's not too bad at a population level, but it is getting more inaccurate every year because the BizG algorithm that's used for race estimation is based just on the last name and zip code of the consumer. So if I were to come, apply for a loan, and then the bank wanted to do fair lending analysis months later, They would look at my last name, Flo, and my zip code, 91320, and they would try to guess my race. You know, I'm Hispanic. I live in a neighborhood where there are not a lot of Hispanic people. And so it would guess that I'm white. It gets it wrong. You know, the data scientist who invented this, Casey Matthews, is African-American, but her last name is Matthews and she lives in Glendale, California. So it guesses white. It gets it wrong a lot. And it's going to get more and more inaccurate as interracial marriage increases and as neighborhoods diversify in America. And so the Zest Race Predictor looks at 11 features that lenders generally are able to collect, like address, first name, middle name, last name, and a few other things like that. And we can dramatically improve the race estimation of borrowers for fair lending analysis. What this means is that a lot of white people that had been counted as minorities are not going to be counted as minorities. And a lot of minorities that were mischaracterized as white folks, or a lot of women that were mischaracterized as men, for example, are actually going to be more accurately categorized, which allows for more advanced fair lending analytics and better measurement of how we are doing on all of these things. Again, Zest is giving this technology away to the world so that we can make fair lending better for everyone. And so in closing, I want to thank you for the important work that you are doing. I want to thank Chris Brummer for this important conference on CDFIs and MDIs and the important impact that they are making on society, and for this opportunity to share Zest's technology and how we want to come alongside those organizations to make financial services work for all Americans. Thank you.
Well, hello, everyone. My name is Nicole Elam, and I'm the president and CEO of the National Bankers Association, which represents the nation's minority depository institutions, or MDIs. What makes MDIs unique is that they are banks that are majority owned or operated by people of color, and they're predominantly located in communities of color. As a result, these minority banks are key to helping advance economic mobility in Black and Brown communities by offering access to credit, oftentimes when other financial institutions will not. FDIC and other data continually show that MDIs originate a substantially higher proportion of loans to Black borrowers than non-minority banks. This is because we are located in the community. For example, 60% of people of color are living in service areas where MDIs are, compared to just 6% of Black people living in the service area of non-Black-led banks. Even with this staggering statistic, the banking landscape is evolving, and people are wanting to do more banking online. According to Experian, 50% of the US personal loan market was served online by fintech platforms in 2019. This is up from 22% in 2015. What does this mean? It means that there's substantial opportunity for fintech partnerships to power personal loans. Under the leadership of the National Bankers Association's Innovation Committee, we started a pilot with Upstart, who is a proven partner to dozens of community banks and credit unions. With Upstart's partnerships, MDIs are looking to do two things. One, advance digital modernization, and two, provide smaller personal loans to the community. With that, I'll turn it over to Dominic Majardin.
Thank you, Nicole. I'm Dominic Majardin, and I have the pleasure of serving as the chair of the Innovation Committee for the National Bankers Association. I'm also the president and CEO of Optus Bank, one of 20 Black-owned banks in America today. Under the leadership of the National Bankers Association, we were fortunate to forge a partnership that addresses two key concerns for most minority banks. How do we deliver credit on responsible and responsive terms to underserved people and places, and do it efficiently and do it in a way that accomplishes our core mission, which is to close the wealth gap and provide new opportunities to access credit that may not be available to our customers and our communities under the normal circumstances. Our partnership with Upstart addresses the first big concern, which is the cost of delivering that credit. The cost of delivering small dollar loans as small as $1,000 by far outweighs any potential return that we could earn while charging responsible rates and offering repayment terms that do not lead our borrowers into the debt cycle and trap them in that cycle for generations to come. Number two, we also wanted to find a way to reach more customers with a new digital channel that would allow us to reach them not just more efficiently, but also reach new customers and new communities and introduce them to mission-driven banks that are serving Americans that have been left out of the traditional financial system. What Upstart is offering us is the opportunity to both increase the volume and also access in our communities, and do it while meeting the needs of our banks, because with no margin, there's no mission. So I'm delighted to share that Optus Bank has launched a partnership with Upstart. We're in the final stages of implementation, and we look forward to reporting great results. With that, I'm going to turn it over to our great partners at Upstart.
Thank you, Dominic. I'm Nat Hoops, Head of Government Relations at Upstart, and thrilled to be partnering with the National Bankers Association Innovation Committee with Nicole and Dom as the first pilot bank taking on this challenge of how to underwrite smaller loans in personal loans in the community and do so in an efficient, affordable, and consumer-friendly way. Upstart is a platform that has really helped pioneer this notion of partnership with smaller institutions, helping them compete in the world of consumer finance with low rate products and really delivering more credit to the community than is typically available by traditional underwriting means. So Upstart, combined with Optus Bank and the National Bankers Association members, will be able to deliver a high volume of credit to LMI communities, that's low and moderate income communities, to individual borrowers who meet the definition of LMI, and specifically focused on closing the racial wealth gap. We know access to credit is critical, and the Upstart model over many years has approved about 30% more Black borrowers at a 10% or so lower interest rates for bank partners, simply by tapping the power of more data in underwriting. And you're really seeing a transformational shift in the policy environment around alternative data. Fannie Mae and Freddie Mac recently announced that they would be accepting rental payment data in the mortgage industry. And so this partnership with the National Bankers Association and Upstart really enables us to both drive volume to the most responsible players in the Black community, that's minority-owned banks, and also learn from them. What are the needs of this community? What are the size loans? What are the terms? What is the repayment like? And so while we like to think that we have a commitment to inclusion at our core, we know that we can learn by working with these great banks and these institutions and leaders like Nicole and Dom. So with that summary of the overall partnership, I'll kick it back to Nicole and sum up what we're doing together.
Thank you, Nat. Well, what I will say is what makes this partnership so unique is that it has been very collaborative from the start. And so thank you, Upstart. Thank you, Nat, for all of your help in helping us develop something that is responsive to the needs of our community and helps modernize our banks.
Hello, everyone. My name is Nell Malone, and I'm on the policy team at Plaid. We were honored to be invited to participate in DC FinTech Week and to speak with you today. Plaid is a technology platform that enables users to connect their bank accounts to financial services applications. We integrate with financial institutions to ensure end users have reliable access to their data through secure methods. Our proposal outlines opportunities for community development financial institutions and minority depository institutions to leverage open finance to better serve their customers. We know how critical this work is. Americans are facing significant financial challenges. Wealth inequality in the US surpasses that of any major developed country, and financial hardship is disproportionately experienced by communities of color. Given CDFIs and MDIs play such a significant role in advancing economic equity, supporting your mission is a critical part of Plaid's mission. We also want this recommendation to reflect that CDFIs and MDIs often operate with constrained resources. Open finance is one tool that CDFIs and MDIs can use to provide customers with enhanced connectivity without diverting valuable resources to build in-house technical solutions. Over the past decade, the financial system has undergone significant transformation driven by both technology and shifting consumer expectations. Consumers are increasingly turning to digital applications and services to manage their finances, often referred to as fintech, a trend that has accelerated significantly as a result of the COVID-19 pandemic. As one provider of data connectivity, Plaid wants to understand how consumers use fintech, how they feel about it, how it impacts their lives, and how that might vary among different demographics. So we've been partnering with the Harris Poll to hear directly from consumers. And according to early results from our poll, 9 in 10 Americans now report using fintech to manage their money, from budgeting and saving to investing and paying off debts. Additionally, 80% of Americans say they can now manage their money without a bank branch. Fintech applications span a wide variety of use cases. For example, Isuzu enables consumers to bolster their credit score by reporting rent payments to credit bureaus. Other use cases include automated savings and investment platforms like Acorns and alternatives to costly short-term small dollar credit like Walnut. Our poll also indicates that fintech is helping underserved consumers access the financial system. Having a bank account is often seen as the first step in leading a financially healthy life, but lower income consumers are far less likely to be banked. Significantly, 1 in 7 consumers making less than $50,000 annually started banking for the first time with fintech. Fintech usage also appears to be more egalitarian, where access to traditional financial services varies starkly along racial and ethnic lines. Black and Latino consumers are both more likely to be unbanked and have reported using fintech at even greater rates than white consumers. Based on 2021 data, these trends in adoption appear to be continuing, if not accelerating. So it's clear there's demand from consumers to access a greater selection of tools to manage their finances. And this greater selection of tools is possible thanks to Open Finance, an ecosystem in which consumers have control over the full range of their financial data, from bank account data to payroll and utilities data. And they can then use that data to improve their financial health and share it in multiple directions, including from fintechs to banks. So to ground this in an example, let's say a consumer walks into a grocery store to buy groceries, but is not certain of their most recent account balance. Traditionally, if their balance is insufficient, their card might be declined or their account might be overdrafted, both of which are very bad outcomes for the consumer. However, Open Finance can offer additional possibilities. If that same person uses a fintech app that allows them to access wages as they earn them instead of having to wait for payday, that person has greater access and more real-time availability of funds to cover unexpected costs because their bank account has transformed into a platform that allows them to build out a series of tools tailored to their individual needs. A bank can provide consumers a significant amount of resources, but each consumer ultimately has specific needs that can't be met by a single source. So while a bank may be able to cover 75% of a user's needs, to close the gap, that person might need to be able to access 1 or 2 additional tailored solutions. Consumers have already started using these tools, and they expect their products and services to work seamlessly with their bank accounts via a connected platform. Open Finance provides the connectivity that allows for the bank to remain the home of a consumer's financial life, while also providing access to additional financial tools, allowing financial institutions to become a platform instead of a one-stop shop. This ultimately results in the consumer having a better financial outcome and being financially healthier and happier. Banks looking to embrace digitization can do so in a variety of ways. Building solutions in-house is an option for some, but it can be resource intensive. Alternatively, Open Finance platforms allow banks to connect to the fintech ecosystem, access that consumers are embracing today and will likely demand tomorrow. Plaid built Plaid Exchange, our Open Finance platform, to meet that need and is one partner that can help you accomplish these goals. Plaid Exchange allows for financial institutions to rapidly integrate with Plaid and the thousands of fintechs that we support via a structured API. We provide a consistent, reliable, and secure user experience across the financial landscape. Plaid Exchange is a low-lift API, and since launching, we've also enabled core providers like Jack Henry, Banno, and Q2 to allow banks on their platform to seamlessly integrate with our API. Financial institutions benefit from integrating with Open Finance in a variety of ways, including retaining account primacy, increasing bottom line through increased engagement, and gaining increased transparency into how their customers are using fintech, insight that then allows those financial institutions to creatively meet evolving financial needs. Consumer adoption of financial services continues to accelerate, especially among financially vulnerable populations and those who have never participated in financial services. Ensuring access to the full financial ecosystem is a vital step in expanding economic opportunity. Open finance is one tool that can be leveraged to better serve customers and, in the process, preserve and scale business. It's easier than ever to build into open finance, and Plaid is committed to making the best technology available to critical institutions like MDIs and CDFIs, not just major Wall Street banks. Please reach out if you're interested in learning more about open finance or getting started on our platform. Our team would be happy to help you. Thank you so much.
Hi, my name is Fabrice Coles, and I'm a senior manager for global public policy at PayPal. PayPal is committed to democratizing access to financial services and commerce. This mission took on renewed vigor and salience in the aftermath of the murder of George Floyd and others during this historic pandemic. The problems of inequality and exclusion obviously predate 2020, but these events did force a needed conversation about what more can be done to invest in underserved communities. FinTech can and should be a part of the solution here, as evidenced by its ability to expand access and deploy new models aimed at meeting unmet demand. This potential becomes even more exciting when one considers the benefits of partnerships with institutions that have long sought to better serve underserved communities. To this end, MDIs and CDFIs, which are mission-driven lenders, are natural partners to FinTech firms interested in making a positive difference toward financial inclusion and health. PayPal has already invested more than $235 million in MDIs and CDFIs since 2020 and sees additional opportunities to expand its engagement in this sector. FinTechs can offer world-class innovation and experience with nimble product and project development that can scale. As a prelude to any next steps, the firm has taken the time to understand some of the key strategic, technological, operational, and general business challenges of potential MDI and CDFI partners. CDFIs served close to 4.6 million individual customers in 2020. About 85% of the funding from CDFIs goes to underserved markets. 17% of lending was in rural areas. 17% was in persistent poverty communities. These CDFIs, MDIs do incredible work, but they want to do more. More than 75% of CDFI respondents in a recent Fed survey indicated they were unable to provide all the products or services they would like to, citing staffing or capital constraints as relevant impediments. And we also know that technology has been an impediment as well. The pandemic was a game changer. Demand for MDI and CDFI services really spiked during that time, and technology has proven to be a key differentiator and value add as business models have evolved to meet customer expectations during this time, which saw digital engagement for financial services really skyrocket. To wit, a study from the most recent FDIC quarterly references call report data and emphasizes the importance of action amidst this backdrop. It found that community banks that invested in tech prior to the pandemic grew their deposits and loans during that time, compared to those that had not invested heavily in tech prior to 2020. So, what does this mean for the future of these organizations and the communities they serve? Well, FinTechs can be instrumental in helping CDFIs and MDIs plug any gaps in technology needs so that they can better serve their communities. In a fast-evolving financial services marketplace, FinTechs like PayPal and CDFI and MDIs can forge various partnerships to improve back-end processes, front-end customer experiences, or even business models. In order to ensure that either of these partnership models is a success, both PayPal and its potential partners must enter into very important conversations about regulatory compliance, especially if that partner is a depository institution. The goal is to improve and scale the service delivery in a sustainable and compliant fashion. So both entities will need to focus on third-party risk management and due diligence, even prior to the commencement of their partnership. These are incredibly important considerations, and the time that the entities take to negotiate these understandings will be critical to the success of the partnership. Now, there are various options for engagement, from customer acquisition support to improving the lending process, to improved RegTech solutions, to payments innovations of all kinds. Each of these areas add value to the service that MDIs and CDFIs are providing in their communities and give fintechs an opportunity to reach new customers and contribute to the elimination of inequalities that have plagued this country for centuries. In order to forge these partnerships, we will ask many questions that need granular answers to ensure the partnership is a success, all with the goal of ensuring that households and small businesses that have been historically excluded from financial access get a hand up as they pursue their dreams. Examples of these questions could be, will a bank partner refer customers to PayPal if they don't meet the bank's requirements for a loan? Will PayPal refer customers to the partner? What criteria would be used to evaluate the customer pool? What service aspects of the relationship will be retained once the referral has been made? Who will be able to market to the customer? Who will provide customer service? And these are questions just for one particular product offering. These are incredibly important and deserve time as well to get it right. So, what more should fintechs be doing? Well, CDFIs can be banks, credit unions, loan funds, and venture capital funds. The real question for fintechs is, how can we add value to those business models? I'll tell you, for our part at PayPal, we're excited about this journey. We look forward to deepening our existing partnerships and forging new ones as well, as we all work together to bolster this amazing ecosystem of CDFIs and MDIs. We want to thank Dr. Brummer and the BIS and all the leaders that are part of the FinTech Week for giving us this time to highlight the important work of MDIs and CDFIs. We're grateful for their work and partnership. Much work remains to be done, and we are rolling up our sleeves along with our MDI and CDFI partners for the long haul. Thank you for your time and attention.
Presentations, and I am just delighted to have a very quick sort of wrap up and a retrospect to look at really what those presentations may have in store, or the good ideas, their limitations, and really how we can think about really bolstering what are the critical anchors to Black and Brown communities here in the United States. I am just delighted to have with me Javier Saad from Fenway Summer, who was also on the Biden-Harris transition team. He's in venture capital. He's been in community banking. He's in small business. It's just a delight to have him with us. Robert James from Carver State Bank, John Davis from the Harbor Bank of Maryland, just up the proverbial road. Three really wonderful experts just to kind of offer their view. Javier, I know that we're already a little bit behind schedule and you won't be able to follow us and stay with us for too very long, but just your quick 2 cents on what you saw.
It'll be probably 1.5 cents. Thank you for setting this up and having this conversation. It is thrilling when you hear these outsized innovators and technologists trying to solve the issues of the most underserved communities in America. Black and brown people make up 100 million people in the United States. And they mind-bogglingly continue to be underserved. I'm not going to talk about any specific presentations we saw, but there are some things in there that were salient, that were kind of cut across a lot of them. Clearly, technology is about ones and zeros. So a lot was discussed around data, interoperability of data, transferring of data, using data to do credit scoring. My perspective is that if we figure out kind of those infrastructure issues, scale, the marginal cost of scaling is as small as it is for any big bank, just because the marginal cost of ones and zeros, one, you establish it. And the second thing that was salient to me is that clearly there's an understanding. The good news is we're talking about this. The bad news is we're talking about this. So the fact, Chris and team, that you got all of these great thinkers to try and figure out how to better and more effectively work with MDIs and CDFIs is important. All this stuff is all well and good, but there are some basic foundational issues that need to be addressed. I'll give you an example. Where I'm from, Puerto Rico, which is 100% minority. I never considered myself a minority growing up. Had a very, very bad storm 4 years ago, which turned off the lights for the entire island for 6 months. If you don't have electricity, you don't have a way to turn on your phone, let alone all of this stuff we're talking about here. So not to be a poo-pooer, but I think you're gonna hear a little more from the next few folks about how there are some real foundational issues. It should not be an excuse to compete, because the future is digital. So I apologize, I have to hop. It's a pleasure. And thank you for having us with this discussion.
No, and thank you for your patience. You are amazing, and Javier, you're just a treasure and a gift. Thanks if briefly hopping on. So I guess what one of the things that Javier was obviously trying to sort of preview, and I think it's really interesting. We have ideas that really span the gamut. We'll talk a little bit more about some of the specifics, but we're talking about questions of better AI, pooling data, as the acting comptroller had spoken about before, data relevant to Black and Brown communities. We're talking about better credit scoring models that we've heard of. We've heard of fintech and MDI partnerships, all kinds of things. But a lot of this, and this is something we talked about earlier, depends on this question of digital transformation. And the question is obviously, well, what happens if you haven't yet digitally transformed? And I know, John, you have some really interesting and important observations on that score.
Well, yeah, thank you, by the way. And I am pleased to be able to share my thoughts about this. I look at the papers, the ideas with this sort of general, sense of the ground truths, right? So you want to know how to actually integrate a system or change a system or come and have an impact. You're going to need to know what the ground truths are. And so to begin, to take what you were saying and what Javier was saying in terms of interoperability, that's a really important point. But before we even get to interoperability, Black and Brown banks or our institutions, we've got to digitize the paper records. And so even before we get to AI, and there's a step before you get to that, because you're going to digitize the records first. And that's a heavy lift, especially when you're talking about a loan department that is already understaffed or that might be at its full capacity. And then you're going to say, okay, now you're going to take all of your people off there and literally go through the process of digitizing every single piece of paper that's in the loan department. Then you go from that department to the other aspects in the bank. The other thing about AI is AI doesn't work unless you've got really robust training data to actually make it work and to have good predictive outcomes. And so when you've got privacy challenges to begin with, and you're going to say, okay, AI is going to solve, it's like AI is not going to solve the race problem in America. And so there's steps that have got to be done in small increments before we get to these grandiose ideas. And the third point is interoperability is real. That is, there's so many different kinds of data sets that don't talk to each other, even internally in our bank. So if one department's not even able to talk to each other, or we're able to look at data from internal, Then in addition to that, you've got our core provider, FIS, and they're saying, hey, listen, I'm not going to even bother with that yet until we do a fix in order to be able to access your data. So there's some preliminary steps I think that need to be dealt with. Then we can talk about solutions.
That was invaluable. And so important. You know, one observation and just one thing that I've said, I literally, you know, am not nearly as expert, but I've always wondered, even just in data and the data pools more generally, if you have, let's say, discriminatory data, it's interesting because you have this challenge of like going through and digitizing banks and going through the records. Weirdly enough, because they are, you know, disproportionately serving Black and brown communities, I almost feel like they're nonetheless sitting on this interesting treasure trove of information that your mainstream banks don't have. And I wonder, what about the commerciability of
de-identifying?
Yeah, I mean, I don't know how in any other way to sort of like to actually, you know, clean your data set with the data that you and that banks that are actually anchored in their community may have, you know, and to try to figure out, like, because a lot of times there's this question of, well, you know, okay, well, you know, you have to go after the MDI data, but they have a unique kind of data, you know, that others don't have, and that itself is an asset in a world where you do have rules against discriminatory lending. And I guess I don't know, again, what to do with that. But
well, the health community, the health industry has a similar challenge, right? Because you've got PHI, PII data, and in order to really run the kind of analysis on the data, you've got to de-anonymize. We got to anonymize the data, de-identify the data, and the other thing is, you know, that data that our institution is holding on to or has is very valuable. And so there appears to be, hey, look, give us all of your data so that they can then come in and create new products on the backs of the information that we have. And we're left behind with maybe some incremental income because we've already sold that data out. So I think that there's a challenge internally, at least from the executive in our bank, that would say, is that something that we want to sell and then let them use to sell back to us?
Well, Robert, why don't I transition to you, you know, with those points. You know, number one, the question of digital transformation. I mean, I had a conversation earlier today with Kimberly Johnson from Fannie Mae, and we were talking about sort of the digital transformation problem. Now, of course, this is with a very large institution with the resources to do that. But she did underscore, you know, just what a massive, you know, undertaking that is. I mean, it's not easy. Maybe though you can just sort of talk about your experience since you were involved in some of these sort of models that are described in the report, and just share some of your perspective.
Sure. Well, Chris, first of all, thank you so much for your leadership and for really, you know, elevating this conversation. Thank you to the Institute for International Economic Law and the Institute for Financial Markets, and to your other sponsors of DC FinTech. I also want to thank all of the teams that presented today. I think all of these are really worthy concepts and ideas. I do want to go back to something that John said, which is that, you know, we'd have to be very, very practical about, you know, where our banks are, and then where our customers are. And so the approach that we've taken at the NBA has been, you know, we're not sticking our head in the sand. We understand that the transformation is happening, whether we want it to or not. So, you know, yes, our records are paper-based in many of our institutions. And yes, we are going through that transformation process. But we do have that challenge. You know, John said, I mean, it's a really practical challenge of how am I going to get an overworked and understaffed loan department to stop what they're doing to get capital out into the community by a process that they know, and digitize those records so that we can, you know, change a process or implement some new process. So the thing that the MBA has been focusing on is, you know, what are some practical things that we can do to either bring a new product or improve on a product that we already offer. And so the thing that I like about what we have started to build out together with Upstart is that it takes a very practical problem, which is that it just takes a lot of time to underwrite any loan, no matter the size. And so if we can, create something that's more efficient to underwrite a small dollar borrower, we can help that borrower hopefully refinance out of a very predatory payday loan type of product, or in my state, you can't get a payday loan. Payday lending is illegal. But what people do is they make car title loans at these, incredibly, 400% APR. And what we want to be able to do is to help a customer refinance that. And so what I'm looking to do in Georgia with the Upstart product is literally to help someone refinance something like that and put some cash back in their pocket, meeting the customer where they are, but also meeting the bank where we are, because it doesn't make any sense for me to put my loan officer on underwriting that individual for a $2,000 loan or a $5,000 loan, or maybe even a $1,000 loan. And that's where the technology can be helpful, and put something that's an earning asset on our books that, we've used some alternatives to decide how to make that loan. And we haven't had to build out some new infrastructure because I've already got an overworked staff, right? So very practical solutions and not so much conceptual is where I think we need to go with all of these concepts. And I think, but I do think that, we cannot we can't stick our heads in the sand and pretend like this transformation is not going to occur.
Yeah, I mean, just again, invaluable perspectives from you both, and I think it's really points to this very interesting question. You can't end up, with a financial services system that's two-tier. We have first-class institutions in our community, in Black and Brown communities, who are positioned with the right tools to compete. I do want to say that Nicole Elam had some really interesting ideas and observations as well.
She sure did. And so, Chris, thank you for mentioning that. Nicole Elam, who is the president and CEO of the National Bankers Association, I'm privileged to serve as her board chairman. But she had some really great observations about the overall presentations. And so, one was that there seemed to be a couple of major themes. One is around credit and visibility, and really tapping into that untapped market of Black and Brown consumers who are just not showing up in traditional credit reports. And so we really want to encourage our fintech partners to help us solve for that credit and visibility problem. It is interesting, at least theoretically, this whole notion of aggregated data insights, if we can solve for the challenge that John articulated, which is to get our data out of that paper and into some kind of digital form. The theory of federating all of our data to help to address this credit and visibility challenge, I think, is a really interesting one. I want to also emphasize something else that John said, which is that we are not going to compromise our customers' privacy at the altar of big tech. So our companies, our banks, we are embedded in these communities. We have a trust that we have built up in these communities over, in my bank's case, 94 years. We have some banks that are over 100 years old. We have a trust factor that's built up in those communities, and we're not going to sell their data. And so these partners need to come to us, not seeking to get this gold mine of data and then resell people a product. And that's really, really critical. The recommendations that we have for fintechs are that MDIs want to be a true partner and not a competitor. We recognize that we can grow and scale much faster if we can partner, but we don't want to end up, in competition ultimately. So work with us from the beginning, and don't come to us and treat us as a guinea pig for some bigger, grander product. We want to know that you've done the due diligence, you've talked to the regulators, you've straightened out your consumer finance issues, and come to us with real solutions. And then for our MDIs, we are very, very concerned with making sure that we're continuing to be compliant, and we want to be compliant from a regulatory standpoint, and most of all, from the standpoint of not violating our customers' trust.
What I find, and I see John just nodding and in full agreement here. It is just sort of interesting when I listen. When you think about an MDI and many CDFIs and many community banks, I mean, that word community means something, and trust is important, and it's literally part of the business model. So part of it is which creates a really interesting question, right? It's not just, okay, you're a new kind of company, we don't necessarily know you, but it's also just the technology itself is new and novel, right? And there's always some inherent risk within that technology. I think, and we'll be talking about this a little bit later in the week. I mean, we have Gary Gensler, and we have the Undersecretary Liam later in the week to talk to. But it's this very interesting kind of risk reward question, which is how do you protect and also enable simultaneously, and that's a very kind of tough nut to crack when there's uncertainty, both in terms of who you're dealing with, what kind of actor are you, and then the technology itself. John.
Great, thank you. Lots to say about that, right? So trust is really what it's all about, right? That we exist, MDIs and CDFIs exist because inclusion didn't exist, right? So we're doing this as a reaction to the larger society refusing to give financial products to Black and brown people. I'm speaking more about Black than brown at the moment, but that's the reality. And so when I hear a comment about inclusion, it usually, to me, it means, okay, so a white company needs to figure out how it can include our people in their own decision-making. It's not about whether a Black company created because of exclusion should now embrace in the inclusion culture. And so in a way, there's a complete disconnect between the industry talking about inclusion and what MDIs and CDFIs stand for. The reality here is, listen, we talk about literacy. I'll give you a simple example. When COVID hit, and we had to shut down the branch down below our headquarters, there's a gentleman standing in line, and he, our bank president went downstairs, and he whispers to the president, he says, can you tell me how to use the ATM machine, right? There is a reality to digital literacy that is in some ways is tied to pride, and that we haven't done this, and now I've got to do this, and now I don't want to ask that question. The other thing is that it's one thing to talk about AI and ML when it comes to theory, but when you're talking about a regulated financial institution, those technologies have to pass muster from the regulators. And so we've got to do extensive due diligence for anything that any outside party that's going to use private data or that's going to be asking to use our data. And so a lot of these ideas are premature in the sense that they've got to pass muster themselves before we can begin to even think about them. And the final point on that is, there are simpler things that can be used, like RPA, right? Robotic process automation, that is simply taking a particular mundane task and having a computer do it. And so RPA can actually improve efficiencies without having to think about bringing on an AI or ML solution that might have bias embedded in the very solution itself that we've seen in criminal justice, we've seen in healthcare and other things. And so I wouldn't want to bring in a solution that we can't necessarily be certain is not going to wind up perpetuating the same biases that caused us in the first place.
Yeah, I want to end on one point, particularly this SSBCI sort of issue, because there's an interesting observation there. I did want to also sort of say, and this is again something that's sort of floated around and gets back to the original question as to like the value of the data that you have, right? It's not just customer data for your own community. I always wonder if there's also value in that data to the extent to which it helps to debias other data pools, right? So to the extent to which you have access to customers and more diverse customers, would the inclusion of your data, even when you're creating greater data lakes, I don't know, does, when I said to cleanse earlier, is there a value to that? Again, from the experience of from what I've seen over at Fannie Mae and with the alternative data kind of issue, it just seems that I've seen, a dramatic, data is one of those things where if you use it well, you can really expand. If you don't, then you really end up narrowing, those opportunities. And the question is, how do you get there with the sort of data companies, and then those trust-based companies that have both a lot of data and a lot of experience and the ability to even interpret that particular data. I did want to just in very, very, very briefly, because we're already sort of massively over time, but Robert, one of those, there was an interesting thing about the SSBCI, question of what do we do, even from a governmental treasury standpoint. Did you have any thoughts there?
Just in closing, Chris, and to use that as a point, the SSBCI, or the State Small Business Credit Initiative, is a Treasury-sponsored credit enhancement to help institutions get more credit in the hands of small businesses that need it, right? And so, what would be very interesting, to your greater point about data, is for fintechs to bring that data to our institutions to make our job easier. And so bring us the data about all of the different credit enhancements that are available to our small business customers that can help us to buy down our risk on loans so that we can make more credit available into the community, instead of taking the data from us and building something on the back of our customer data. And I think if we can have partnerships like that, where you bring something to us to make our job easier, rather than taking something from us to prey on our community, I think those are the solutions that we would like to see. And those are the partnerships that our NBA member banks and MDIs and CDFIs are going to endorse going forward.
Just such an interesting, such a useful and valuable conversation from two of the best. Thank you so very much. This is a great ending for a day that, as I said, has started and literally spanned the globe, but some of the pressing issues at home still need taken care of. Thank you so very much to our audience in the United States and around the world. Thank you so very much. We'll be starting up nice and early with yet another day of our FinTech Week conversation, really focusing on some of the issues that we heard about today: privacy, the integrity of information, the integrity of our financial system, and we'll have many of the world's leading experts from cybersecurity to FinCEN to talk about those issues. Till then, thank you, and I hope that this has been a useful and productive conversation.